Comfortable seats. Really comfortable. No, sometimes I don't sleep. Lock that door. People walk in the main door. Started. Good folks that showed up on time. Good to go. All right. So we're going to go ahead and get started. We do know there's probably at least 3 or 4 more families that are on their way. If they come in late, please do not let them interrupt. Also, we do have people that are going to be on Zoom throughout Texas and then also other states of people that are looking to relocate out here. So if you guys see me looking at that camera and you're like, who is this guy looking at? It's the Zoom people out there. Okay. All right. So before we get started, for those of you that are here locally, you should have this very nice, fancy folder with a bunch of stuff in it. Okay. If you guys are on Zoom, you should have most likely the home buying guide, and then also the 2 flyers, which actually we're going to use for the class today. The first one is called The First Steps to Buying a Home. The other one is called The 5 Factors of Credit Scoring. Okay. Also, in your packet, you should have a blank piece of paper where you can take notes. I'm going to put out a bunch of information today. And if you would like to, go ahead and write your questions down and simply raise your hand. We can cover those. Okay. This is kind of like a classroom environment where we can share with one another. I do not mind if you raise your hand and say, hey, I have a question, because the question that you probably have, I'm sure everybody else in here is probably thinking the same thing, right? So the goal of today is when you leave, you should thoroughly understand the entire home buying process, from credit, mortgage financing, and then also the process of buying a home, okay? If you leave and you're not thoroughly familiar with the process, then that means I didn't do my job, okay? That makes sense? All right. Thumbs up if it makes sense. All right, we're good to go. Okay, so first things first, let me talk to you a little bit about newhomeprograms.com. How did you guys even find out about us? Anyone? How did you find out about Brent? Brent. Ah, okay. Well, how did you find out about Brent?
He's a friend of mine.
Ah, friend, okay. How about you?
I got it through, I guess looking at my phone.
Just bam, God gave the sign. Would you like to buy a house and be invited to a seminar, right? They say God works in mysterious ways, and I believe Facebook is not all of the devil. It can be used by God as well. All right, how about you guys?
Co-worker.
Co-worker?
Mhm.
Okay, is this someone that went through our company to buy a home? Okay, was it a good experience?
Yes, one of the regular, home.
Okay,
You guys said, oh, it's a process.
okay,
Yeah.
great, great. How about you guys way in the back, guy and gal? How'd you find out about us? Internet? Facebook? Okay,
Yes, sir.
okay, good. So, newhomeprograms.com. What is this all about? Because a lot of people say, I've heard of Remax, I've heard of Century 21, I've heard of Keller Williams, but maybe you've never heard of New Home Programs, right? Well, we are a real estate company, but we're different in the sense that we're not a franchise. So we're not cookie cutter. This is a company that we started back in 2004. And when we started it, we had a purpose. The purpose was that not every human being is exactly the same, right? Would you guys agree? Nobody's the same. So anytime we're looking to do something in life, sometimes we're on a different path than what other people are on. So nobody has the exact same job. We don't have the exact same credit score. We don't have the exact same desires. And even if you said, I want to buy a house, probably everybody in here would say you want a different type house than the next guy. So we understand that people are different. And when getting started in the home buying process, we also understand that there's roadblocks that people are going to face. For example, credit. That's the number one roadblock. And it's not because people like to have bad credit. Some people have no credit. So by the time they say, I want to buy a house, and they go to a bank, the bank's like, you don't have any credit, right? Or you don't have enough credit in order for us to let you borrow money. Because these aren't things people teach us in school, right? Anybody go to school to learn how to buy a house? I know I went to school and I had to take home ec. They taught me how to bake cookies, right? And wash dishes, but they never told me how could I actually buy a home, right? So because we don't know the credit requirement, a lot of times credit becomes an issue for a majority, okay? Also, to get a home, unless you're going to pay in cash, right? Sometimes you need money for down payment. Does anybody know what the minimum down payment requirement is? Anyone? See, most people have no clue, because why? Nobody teaches you that. They don't teach you that in school. And when you get a job, your employer doesn't say, hey, we're going to pay you a salary. What are you going to do with your money? Oh, you want to buy a house? Let me show you how you can buy a house, because you're working 40 hours a week, right? And who wants to work 40 hours a week and have nothing to show for it? At least get a house, right? You know, so nobody ever teaches us this stuff. So this company was designed around different roadblocks or issues, or you could even call them problems, that people face when buying a home. So for example, we have people that say, I have a piece of land. My mom gave it to me, my dad gave it to me, or maybe I bought a piece of land 5 to 6 years ago with the dream that one day I can build a house, but I have no idea how to do that. Build a house on your own piece of land. It's called the Build on Your Lot program, which we offer, right? Credit enhancement program. People say, well, I got turned down from the bank, or I want to buy a home, but I don't know if my credit is where it needs to be. Well, our credit enhancement program is designed to pretty much take anybody and put them in a position where they can get a good mortgage loan. Now, what is a good mortgage loan? It's open for interpretation, right? For me, it's least amount of money out of my pocket, down payment, right? And then a least amount of money out of my pocket over the next 30 years if I get a 30-year mortgage. Because at the end of the day, I want to have something in my pocket left over, right? So this would be example, for example, first-time home buyer program. We have people that are coming from different countries, international buyers. They have no idea their rights in America to be able to purchase. So we have that. We have the lease with the right to purchase. Is someone who says, I want to rent a property to get to know it. And then maybe in a couple of years, maybe I'll buy it, right? So these are examples of programs that are nothing more than what? Solutions to help you to buy or to sell homes. That's what the name New Home Programs is all about, okay? So we are a real estate company. We're not a franchise. We built this company from the ground up. We've been in existence since 2004. We've helped thousands of people in this area, but we also cover Austin, Dallas, San Antonio. We're in Florida, and then also West Virginia. You're probably thinking, why West Virginia? Because that's where I'm from, right? And I always want to go back to my own hometown and be able to help the people in my local community, okay? So that's who we are. We are a real estate company. Now, over the years, again, we've always changed according to the needs of the people. In 2017, we saw that a lot of people really had a need to be able to not just get a home loan. Remember we talked about what a good mortgage is, least amount of money out of your pocket today and over the term. So what we decided to do, because many banks were having all kinds of stuff that they were doing, but they weren't making the people happy. So in 2017, what we did was we also became a mortgage company, right? That's that model mortgage right there. Now that is a franchise, okay? We didn't have time to build a mortgage company up from the ground up. So we bought a mortgage company, and now we're able to help our clients to be able to get all types of loans. For example, for international people, we do have what's called the foreign national loan. We have I-10 loans, we do FHA, VA, conventionals, and even USDA if you want to live in the country, right? USDA is any type of loan where there's less than 10,000 people in the area, and it's no money down with a low interest rate. Okay, did you guys know about that? Okay. A lot of stuff out there that we're going to cover today, and hopefully you're going to know everything. All right, so on this sheet right here, I just covered the intro, New Home Programs, our story. All right, so let's get into talking about credit. Credit to me is the most important part of this entire class today. Why? Many years ago, before there was a newhomeprograms.com, I used to work for one of the largest family-owned builders in this city, Royce Homes. Anybody remember Royce? You've heard of Royce Builders? They were around for about 24 years, but after the last housing bubble of 2006 and 7, they actually folded after 24 years. They had about 32 neighborhoods that they were building all over Houston and all the metropolitan area. I was the guy that when someone called in off of a television commercial, or maybe they walked into a neighborhood that wasn't a fit for them, they would call me up, and then I would drive them around to find the right community within the Royce empire, okay? The first person that I ever had that wanted to buy a home with Royce, I showed them the property. They loved the property, and I went ahead and did the paperwork for them. But as someone new in the business, I didn't know anything about the mortgage side of it, right? So when that person put the contract on the house And then a week later, they applied for the mortgage, they got turned down for the loan. And being someone new in that industry, I said, well, wait a minute, Royce, you just told me I had to show the houses. You never told me anything about financing. And that's when I learned very quickly that everybody wants to own a home, but the credit issue is the number one thing that stops them. So what I decided to do at that point, because I'm the type of person, I don't like negativity, right? I don't like to tell people no, and I don't like to tell people they can't. So what I did is I devoted myself for about 3 months to learn how credit in this country works. Because believe it or not, the way our credit works here is not how other countries have credit, okay? Our credit here is based on a mathematical algorithm, and you guys have heard of TransUnion, right? Equifax and Experian. So the goal was, if I was to learn the mathematical equation that calculated a person's score, then all I had to do is educate that person on how to get the score up so that they can get the financing. Then we can move along to purchase the house. See, a lot of people do it backwards. They go find the house, they put a contract and their money down, and then they try to go find the financing. Because isn't that how we do it in the car industry, right? You just walk in, like, I'm just shopping for a car. They let you test drive the car, right? And then once they get you hooked on the car, they're like, okay, is that the one you want? Here, I'm going to take you to the finance people and let's see if you can afford the car or qualify. You see? So some people in their mind, they think that's the same way that they need to buy a house. Well, look at the house first, find the one you want, and then try to get the financing. But the problem is, it is a lot more difficult to buy a home with a mortgage than it is to get a car. Okay? So let's talk a little bit about credit. So I have some bullet points on this flyer. So the first thing you need to know is that you do have access to a free credit profile every year through the free credit annualcreditreport.com. Okay? Does anybody even use that? Nobody uses it, right? So the government came out with that more than a decade ago, but then Credit Karma came out. So now everybody can at least get what's your credit profile, which means what's on your credit, but also you can get a credit score. So once Credit Karma came out, it's like the government stopped pushing the free credit profile because you don't get the credit score. But I still have to tell you that it exists. All right. So Credit Karma became the king of credit scores. Now, question. What is a credit score? Does anybody know? And I know it's a number, right? But what does it mean? What does it represent?
I think that's how much potential you have to buy a house.
The credit score, so you're saying the credit score determines the amount you can qualify for or potential. Okay. Anyone else?
Work on a balance for the year.
Okay.
Good or bad, rates.
Okay, I like that report card. It's the first time I heard that one.
Kind of how I see it.
Yeah, this is true. Anyone else? Okay, very simple. It's a mathematical score that determines risk. It's a risk factor. Okay? So the higher the score, it tells someone that you're trying to borrow money from that most likely you're probably going to pay them back, right? The lower the score, they're going to say, I'm not going to give you money because there's a good chance you're not going to pay me back, right? So that's really what a credit score represents. It's a risk factor. Now, can anybody tell me what is that magic score that you need to get a good home loan?
740.
740? Wow. Anyone else?
There's a low number and there's a high number. Can I get both?
Oh, you try to play tricky. You want to give two answers. Okay.
So I think the lowest is 580
Okay.
and the highest is what, 6?
The highest? What if somebody had an 800? Are you
Well, no.
They
Well,
can't get
that's
a
the
loan?
lowest. That's the lowest.
Okay.
Well, the lowest is 580
Okay.
to get for the FHA loan.
Okay.
And for the conventional loan, it's 640.
Are you asking or telling?
It's 640.
Okay. Anybody else?
620.
Oh, man, she keeps on changing her answer. Anybody else?
645 online.
645 online? Okay. You see how we're kind of like all over the board with the score? And you guys just showed up, and we talked a little bit earlier today, that when you go to high school and even college, they don't teach you about credit, right?
Right, no,
Let me ask you a question. Why don't you think they teach you about credit in college?
because they're using credit up.
They're using your credit up. How do they use your credit up?
Clients, I mean, loans.
Loans.
Student loans.
See, when you don't have the best credit, they can get a little bit higher interest rate, right? And they're in the big colleges or in the business, the banking business, the finance business, right? So they have a vested interest of you not understanding your credit because why? Most people do go and get loans to go to college. So why would they educate you on that? So just want to throw that out there. So if I mention stuff about colleges, it's because I'm kind of disgruntled with college, okay? So anyway, now, credit score. We were talking about what is it about, and now we're going to talk about how is it calculated. By the way, we will go back and answer the question of what kind of credit score do you need to get a good loan? So keep that one in mind. Now, up on the board, for those that just showed up, if you open up your folders, go ahead and pull this one out. Just in case you can't see all the way up here. 2 months ago, I could be sitting right there and I couldn't even see this, but then I got LASIK surgery. So now I can actually see everybody in the room now.
Now we don't get stuck in the video.
Before I had to say, hey, is there people here? I can't really see anybody. All right, so the 5 factors of credit scoring. Now, first thing we have to understand is that there's 3 different credit bureaus. Who can name them?
Equifax, Experian, and TransUnion.
You got it. Okay. Now, even though there's 3 credit bureaus, who can tell me at least 2 different types of credit scoring systems?
Psycho and Vince.
Man, she did her homework. Did you watch one of my
Nope.
seminars on
Yeah.
YouTube? Okay, I do got it on YouTube. Okay, she's right. Which one does Credit Karma use? Vantage. Which one do mortgage companies use? FICO. So even though you have the 3 credit bureaus, based on the industry of what you're trying to buy, car, home, credit cards, things like that, they could use 2 totally different scoring systems. And you got to know which one. Because if you're trying to get a mortgage and you're basing your scores off of the Vantage 3.0 system, which Credit Karma uses, but also credit card companies that give you the free score, like Capital One uses Credit Wise. That's a Vantage 3.0. So don't say, hey, I have a 700 credit score because my Capital One card says that. And then when you get your credit pulled by a mortgage company, it may not be 700. Okay. So it's very important to understand how these softwares work. Now, first thing, even though there's 3 different credit bureaus and a minimum of 2 different scoring systems, I'm going to use a credit range of 309 to 839, right? So if someone says, well, wait a minute, does it Experian go up to 850? It is possible, but then again, they use 2 different scoring systems. But I have to have at least a baseline to get started with, okay? And this is a good baseline. I believe I pulled this from the TransUnion's model because they have so many different models. But the main thing about it is there's always a high score that you can't go over, and there's always a low score that you can't go under, right? So the difference between the 2 is 530 points, right? So if you just subtract 309 from 839, you have a possible 530 points that you could put your hands on. So my way of thinking is, if someone said that I had a potential of 530 points, my next question would be, how can I get my hands on 530 points, right? So let's focus on that, trying to get as many points as you can, because it makes understanding this a little bit easier, okay? Now, how can we do it? Number 1, because there's 5 different ways you can do it. Number 1, which is the most powerful one, is how you pay your bills. Now, let me tell you, how you pay your bills is you pay it on time, or you don't pay it on time. You pay it 30 days late, 60 days late, 90 days late, so forth, until eventually you just say, I'm not gonna pay it, and then it becomes a collection, right? So, looking at the number 1 factor, the most powerful factor, 35% of what? 530 points, right? So what is that? 185.5 possible points you can put your hands on, right? So if you started at 309 and you were perfect in this, you always made your payments on time. then you would automatically be at 494.5. You see how I broke this down, right? Make it very simple. You just got to learn to master each of the 5, right? This one is the easiest one. If you're gonna get something on credit, number one, make sure you can pay it, right? Because if you know you can pay it, then it's just payment. And then you master it. Now, if you have something that, I don't know, COVID happened, how many people got laid off, hours got cut back, right? Nobody in here. Oh, blessed. So even if something bad like that happened, right, and you want to continue to master this, what you need to do is you need to call that credit card company, even your mortgage company, right? And just say, something bad happened in my life. And because I've always paid my bills on time, I mastered it. I need a little bit of help. Anybody ever asked for help before? I struggle with that sometimes. I'm a military guy, right? It's just like, you're not supposed to ask people for help, right? Get out there and just fight the war. So, but the thing is, you can ask for help. And they may have mercy on you to the point to say, you know what, you have paid your bills on time. What I can do for you is stop your payment, maybe 3 months, 4 months, 5 months, right? And if you don't have to make the payment, that gives you time to get back up on your feet. Because here's the thing. You want to make sure that you protect this one because it is the most powerful one that determines your credit score. And it's not just about the credit score sometimes. If you were to get an FHA loan, right, as she mentioned, FHA, you can have a 580 and get an FHA. You're probably not going to get the best interest rate, but FHA isn't just credit score driven, right? It's payment history driven, which means in the last 12 months, they don't want you to have more than 2 30-day late payments. They will let you have up to 1 60-day late, right? So that's why sometimes people with a 580 can get an FHA. It's because they did have late payments, but probably they were outside of the 12 months. It dragged their score down, but in the last 12 months, technically, they weren't late, or they had 1 or 2 lates. Those are tolerable for FHA. That's how you get somebody with a 580 who says, I got FHA with a 580. It's because of that. Okay? Makes sense? All right, so number 2, revolving balances. The second most powerful factor, 30% of what? 530 points. You can get up to 159 of that right there. It's based on your revolving balances. Okay, so let's talk about revolving. What is revolving credit? Anybody? Credit cards, okay. That is an example of revolving. Anyone else?
Loans,
Loans, like what type of loans?
automobile, finance,
Keep going.
mortgage loan, I guess, I don't know. I don't know any of them.
The one that most people know are the credit cards. These revolving balances are credit limits that you're given that you can charge it up and that you can pay it down. That's what you call a revolving line of credit. So for example, there are some furniture stores, I think Mattress Mac, he may still have, I don't know if Gallery Furniture has a credit card, because I think they have 2 different ways you can get money from them. But it used to be back in the day, Mattress Mac, Gallery Furniture would say, you're approved for $5,000 worth of furniture, but you never got a card, right? So you go in and buy a couch for about $1,000 and you pay it down. And then they send you a flyer in the mail and say, hey, you got the 5,000 line of credit. Why don't you come in? So you charge it up and then you pay it down.
So like a SEMA, a SEMA.
A SEMA,
So,
it's kind of like also like Finger Hut too. When you get to buy stuff to
okay.
their book, right?
Yeah,
So also sometimes people give what's called a Heloc loan. It's a home equity line of credit against their house, where they're borrowing against the equity in their house, and they charge it up and they pay it down. So look at this. It's kind of like when you go to a fancy hotel, right? Typically downtown, and they got that revolving door, right? And they've got someone who always stands there to help you with your bags and everything, right? And even at 1 o'clock in the morning, that door don't never lock. It stays open 24/7. People go in and then they go out, right? But it never closes. So revolving credit, like a credit card, is you have a $10,000 limit. You can charge it up and then you can pay it down. You can charge it back up and then you can pay it down and it don't close, right? Now, the opposite of revolving is an installment loan like a car. You borrow $25,000 and you keep making the same exact payment based on terms. 1 year, 2 years, 3 years, right? 4 years. And then when you make the last payment, what happens? It closes. She said you get title. It close first, and then you eventually get your title, right? So that's an installment loan. You're making the same installment payment, and then once you make the last payment, it's closed. But the revolving credit card, it can stay open forever. Okay? Now, we're talking about revolving. Revolving credit, 30%, which you can get up to 159 points. Now, let's talk about revolving because this is one of the most dangerous parts. Whoa, we're already done? So revolving is the most dangerous. So let me just give you an example. A lot of people don't believe that if you don't have enough credit, you could just go get a secure credit card, right? For like $300 limit. And people are like, are you crazy? I can get a $300 credit card and a bank's going to give me $500,000 to buy a house just because I've been using this little $300 credit card? Yeah, it's true. Because why? They just want to know, do you have a credit score and how do you pay other people back? Right? So the problem is people don't take that little 300 credit card seriously. So what they'll do is they'll charge it up with gas. Like how much you guys paying for gas every time you fill up now? I'm paying like $60, right? 2 years ago, it's probably $39. So it is very quick. You can charge up a $300 credit card. Most people probably spend $200 every time they go shopping for groceries if you got kids. And I'm telling you, because I got 2 kids, right? So I go through milk and bread like every 3 days. So the thing is, when you get those smaller credit cards, it's easy to rack those balances up, right? And the problem with revolving credit is this. When you charge a credit card up, automatically your credit score drops. And it don't matter how well you pay people back because it's tied in to your credit card usage, right? So you guys have probably heard it said that if you keep your balance at what, then your credit's gonna be good. You said 30%? Anyone else? 80%? 8%? Okay. No? Okay. Okay. So here's the thing. A lot of people say a lot of stuff about where you should keep your balance. What I'm telling you is, and this is the truth, mathematically, when you charge and have a balance, your score drops, right? So even if you get on any type of simulator online, even at an 8% balance, right? It'll say if you pay it off, even if you get 5 extra points, isn't it true? Your score will go up. So the thing is, I would say keep it at 0 or at least 1%. Okay, because at the end of the day, you just never know when you're going to need those extra couple points. Now, let me tell you how important a couple extra points are, right? Because I'm showing you have a potential of 530. But what happens if you have a 639 and you qualifying for FHA, right? And you end up getting a 4.9% interest, but then your friend has a 640, 1 point higher than yours, and they're getting a 3.9. It don't make sense because your credit's only 1 point difference, right? But that ain't how mortgage financing works. Banks set an actual score, right? That if you're at this score, you get this rate. If you're at this score or range, you get this rate. So sometimes one little credit point can make the difference of you qualifying for a $200,000 home or a $210,000, because the difference of 1% in an interest rate, it could be about $10,000 difference or more, right? See how important it is? So that's why I said it's very dangerous, this revolving credit stuff. Because again, a lot of people don't got the enormous credit lines, right? Most people are carrying on one credit card probably a $500 to $600 limit. Like if you get the Walmart card, which is really Capital One, typically they start you off under $500. Most likely $300 if you have no credit. See, and it takes you a while to even build it up to $600. So when we see people come in and we run their credit because we have a mortgage company, typically this is what we're seeing, and we have to tell them, I know it's no big deal. Your credit card is $300 limit, but you owe $250. Just go ahead and pay it off. Probably your score is going to jump 15, 20, 30 points because remember, you have a margin of 159. Okay. Now, many years ago, when I say many, more than a decade ago, I wanted to test this theory about that 159 points. So what I did was, my score at that time was probably like maybe a 17, right? I charged all my credit cards up to the max. I literally saw my credit go from a 710 all the way down. Some of them, right, went down to like a 590. Two of them were hovering around 605, 610. Now, I couldn't believe my eyes because I'm like, I wasn't late on anything. All I did was I charged my credit cards up, right? And I knew that I was going to pay them off as soon as I saw, the drop, right? So I realized very quickly that this calculation, it is legit. Now, I dropped about 100 points or so, but it does say you have a potential of 159. So that bugged me for a couple weeks because I'm like, if I maxed it all the way to the limit, why didn't I drop 159 points? Can anybody tell me why I didn't drop 159 points? But see, how I paid them on time is irrelevant when it comes to the balances. Does anybody know? How can you drop 159 points? What was that? Closing? No. This right here is only based on balances.
Oh, so you had to use 30%.
Let me tell you. Anybody ever charge a credit card over the limit?
Oh, yeah.
When you go over the limit, you are in a really bad area, right? That's how you can drop 159 points. See, if you just max it to the limit, you'll probably drop 100. But if you go over the limit, that's where they get you for the 159 points.
If you max it to the limit, but you pay it back right on time whenever it's due, that doesn't matter.
It's a snapshot in time.
Right, so, okay.
So
only if you go past
If I'm maxed and they take a snapshot and they say you're maxed at that time in history, that's what my score is. So I'd have to pay it down and wait for the next snapshot, which is every 30 to 45 days, right? Get it? Now, let me show you. Here's one of my little secrets, my little tips. Because you guys, when you show up, I'm going to give you a bunch of tips, right? So it'll give you the advantage, right? All right. Who uses Credit Karma? Everybody probably uses Credit Karma. Okay. So if you got your Credit Karma account, go ahead and click it open. I do the fingerprint deal. I can't remember all my passwords, right? So when you see the two little circles pop up, just click on one of them. Okay. Once you see it, the circle, go down to the part where it says credit factors. And then go down to where it says credit card use. Okay. So as you can see at this moment in time, mine is at a 5% balance. Okay. Now, once you see the total percent of your balance, scroll down a little bit more and just click on any credit card. It doesn't even matter which one. Now, once you click on it, you will see the name of that credit card. And what does a little fine print say right under? The last date it was reported. So mine being a capital one, which I have 3 capital ones, just because you have several credit cards by the same bank, it doesn't mean they always report all of those cards on the exact same day. Right? So don't get fooled. That's why you got to always keep your Credit Karma account, right? So mine is saying that the last time it was reported was February 16th, which was a couple weeks ago, right? Sometimes even that date fluctuates 2 days on the back end, 2 days on the front end. So what I do is I monitor it like a hawk, right? You can even put on your Gmail calendar, your Google calendar, whatever Outlook calendar. And what you need to do is Right before you know you're within that probably 5-day window, pay it down. Right? That's how you game the system. You never want to be in a position to just walk in and say, well, I'm thinking about buying a home today. Go ahead and pull my credit. No. You got to be thinking 30 to 60 days out. I think I want to buy a house. I'm not sure, but let me go ahead and make sure that I start paying down everything. Because why? That's 159 points you have up for grabs. Right? So that's how you know. Now, the date that they report is coordinating with your billing cycle. So most likely around that 16th of the month for that particular Capital One, I am getting that bill in the mail, and it does say you have up until 30 days to pay before I become late. But the day that you see it on that statement is probably somehow going to be close to that date that's reported here. Okay? So that's how you game the system. Find out when it's going to be updated with the credit bureau, and then hurry and pay it. So I can tell you my life is what I do. I got the Walmart card, which is really Capital One, right? And I got an Amazon deal. So what I do is I don't even go to the grocery store anymore. I just buy it from my phone. I just all my grocery right here, right? They bring it to my house. I buy it, right? And then as soon as I'm getting ready to come up on that billing date, I go ahead and pay it. Because why? I get the points. And if you use the Walmart card, sometimes online, you see that they drop prices of stuff. They don't ever drop prices in the store, right? You go in the store and they don't even have product. Everybody bought up everything, right? But on the online store, you can see that they got a discount. So I buy it at a discount, right? Get the points. And then once I rack up like $200 worth of points, then I buy my next set free. And then I keep my credit going up. And then I keep increase my credit line with Walmart. So right now, my Walmart card, I got like $8,500. I can buy like 90% of the stuff that Walmart sells through that Walmart credit card. And I keep racking up the points and getting free food for my kids. Yep. You gotta learn how to game the system. All right, so revolving credit. Now, here's some more tricks and tips. Let's say that you have a credit card limit of 1,000 and you're 50% maxed out, which means you owe 500, but you could charge up to 1,000. And you need to get the extra 1 point to get from 639 to a 640 so that you can get a lower rate. What's the quickest way that you could get your score to go up at least 1 point without even having to make a payment on the balance? What was that? Credit limit increase, right? Because here's the thing. That overall credit balance, if you have multiple cards, it's taking the average balance across all your revolving accounts. So for example, if you have $1,000 credit card limit and you owe 500, right? And you increase that limit to 2,000, are you still 50% maxed out?
No.
Not, right? About 25% maxed out. That's one way. The second way is you got $1,000 credit card, $500 what you owe on it. I can open up another credit card. So let's say the other credit card company gives me $1,000 limit. So now I have $2,000 limit with only $500 balance across both cards. Isn't it the same thing? I went from 50% being maxed out balance to 25. You think I could get 1 point from that? See? So people will say, well, how many credit cards do you think I need to have? Right? Based on mortgage guidelines. If it's FHA and VA, which is for military folks, any military folks in here? Military folks? Those are both under what we call HUD, Housing and Urban Development, right? And they have somewhat similar guidelines. So when they are able to insure a loan, they want to see at least that you have 2 open accounts that have not been closed in the last 12 months. So that's why I'm saying open accounts, right? 2 open accounts that you have not been late on in the last 12 months. So at a minimum, if you don't have a car and you don't have a student loan, at a minimum, get at least 2 credit cards because you can leave them open forever, even if you didn't use them, right? So have at least 2. And a lot of people say, well, what type of credit limits should I get? Well, that's up to you based on what you want to do. But my advice is, because we don't know how this economy really works when crazy stuff happens, like who would ever think that because they're having an issue over there with Russia, right? Our gas prices are going to go up and it's going to hurt a lot of us, right? And we never, lift a fist at anybody over there. But the thing is our economy is so finicky, like literally it can snow and hurt our economy here in Texas. So the thing is, I tell people, when you have credit cards, try to build up your limits to the point that if you got into a bind, at least you can pay the majority of your bills using credit, right? Because why? If you get let go from your job, isn't it true that when you got bills coming up, you're under stress to find a job because your rent or your mortgage and your car payment's coming up, right? But doesn't it make sense that if you knew you had, let's say you make, I don't know, $3,000 a month, and you had $9,000 credit card limit, right? You could probably call the car company and they'll say, you know what, don't even worry about payments for the next couple months. You probably could call the credit card companies and they'd probably put a freeze on them, right? But you still got utilities. Good luck trying to get away not paying, for electricity and gas, right? But if you had 3 months that you could be pulling from those credit cards so that you had enough time to interview, maybe you find a better job instead of taking the first thing like working at IHOP because they can't keep people down there. Anybody a general manager? Because they need a general manager bad over there, let me tell you. So, but that's my suggestion is if you're going to work on building up your revolving credit, have a goal. And the goal should probably be where it covers 3 months of your lifestyle, okay? And then keep your balances pretty much at zero and use them in a case of emergency or to scam the system and get the points so you get free stuff. Because that's what I do. All right. Okay, so that is revolving balances. Anybody have any questions about credit cards, revolving balances? Because I know some people say credit cards are the devil and they don't ever want to get them again because they messed up when they were like 18 years old. And that is true because you didn't know how to use them, right? You didn't know how to take advantage. No questions? Okay. The third thing, limit of credit history. 15% of what? 530 points equals what? 79.5. That's almost 80 points. Now, this one right here, this one is the most overlooked factors of credit scoring, right? Most people don't understand this one. But what I can tell you, let me give you an example. Anybody ever got a mortgage before? A home loan. Okay. What is one of the things that they tell you, your loan officer tells you, when you have already been pre-approved for a loan? What do they tell you to do, not to do? What was that? You don't remember? Okay. They tell you, don't open any credit and don't close any credit.
Oh, yeah.
Why do they say that?
I guess what is the pre-approval process,
Okay.
right?
Okay.
Like if you're in that process and you go to the store and get a whole bunch of furniture and
Okay.
everything, and at the point to where I guess you're approved, you can lower your points.
Okay.
Your score or something.
Okay.
I mean, I've never gotten a house before, but I've heard people talk about it.
Okay. So let me explain.
I was gonna say this with the credit history, like, even though I've had credit for 18 years, when I look at my limit history based on like my open accounts, I only have a year of credit history that's important.
Okay. And she did this, open accounts. See that? That's air quotes, open accounts. Okay. Let me show you something. Back to the Credit Karma. I think Credit Karma should give me like royalties since I always talk about it. Let's go to the circle again. Right? Choose any circle, don't matter. And when you go to the circle, scroll down. Circle is the big one with your score. Okay? Go down to where it says credit age. Now, if you look at mine, I got a bunch of greens, right? And then I got 2 reds. One of the reds is the credit age. Mine says 4 years and 2 months. Like you said, you could have 18 years of borrowing money, but then they say you only have 1 year because why? They only base it on open credit, right? So when you click on it, it'll say what your total is based on all the open credit. Mine says 4 years and 2 months. Now, I know I've had mortgages that were like 13 years, right? I got credit cards that have been open for about 12 to 13 years. So how in the world is this my average? Well, it's very simple. The first thing you have to do is underneath that amount of time. What does it say? Under the amount of time in the fine print.
The average age of your open.
Open accounts, right? So this is how it works. If you have, let's say 2 credit cards, right? And Now, let me make another example. Let's say you have one credit card and it's been open for 10 years. And you're approved for a mortgage, right? And based on the 10 years, I know based on that factor, it's the highest level you can be, which means you are getting 79.5 points, right? Because once you hit 9 years on average, then you topped out. So you got a 1 year, you got a credit card, one credit card, 10-year history. And now you got a pre-approval and a contract on a home. Because you know, probably you get a contract on a home, you ain't closing for about 30 to 60 days, especially if you're building a house, right? And what's the bank going to do right before you close? Rerun your credit and then call your job to see if you still got a job, right? So you got the one credit card, 10 years. You get excited and you go to rooms to go, right? And they issued you a credit card. In 30 days, it's going to pop up and say you got 1 month history. So you got a 10-year history in a 1 month history. You now have two accounts, right? So they add the 10 years with the 1 month. So that's 10 years, 1 month divided by 2. What do you get? 5. Guess what? You just lost about half of that right there. That's about a 40-point drop.
That makes sense.
And then the bank goes and rerun your credit. Say, hey, you was at a 640 2 months ago, but you ain't at 640 now. You at a 600. And now I got to give you a 4.99.
That makes sense.
Right? So you don't want to close an account. So some people say, well, I'm about to get that income tax money, right? And I only got $5,000 left to pay on my car, and my car payment is $600 a month. You know, people in Texas drive a big truck, right? In West Virginia. So $600 a month, that's a lot of money to be paying for a car. And their way of thinking is, well, I can afford that house payment of $1,500 a little bit better if I didn't have a $600 car payment. So let me go ahead and pay that car off that I've already had for 6 years, right? So when you take that 6-year open account out of the equation, that can hurt you. Because let's say your average is at 8 years and you take a 6-year out, it could actually drop you, right? So that's why you don't want to pay nothing off and close it. You can pay a credit card down, that's fine, but don't close it because why? It's based on open accounts.
I have a question.
Question.
I have a question. So I had a small Best Buy
Okay.
account and I never used it.
Okay.
I just used my 2 favorite credit cards. And they closed it. They closed it like in January. And if you don't use it, they will close it. So
Some will.
my question is, since I'm trying to purchase a home, should I just leave it alone or should I try to get them to open it or?
So
what should
here's
I
the
do?
thing. Each credit card has a specific account number. If they're going to issue another account number, then you do not want to do that. If they can open it with the exact same account number and ask them, same account number, and will I get all the reporting history reestablished? If they say no, then don't do it. Okay. Okay, so we got a question over here. Let me see. I have a high credit score with 1 credit card. Do I need to open up another? So we don't, because remember, if you got the credit and you have the number of open credit, on FHA and VA, they want at least 2 open accounts that you have not been late on in the last 12 months. If you get a conventional loan, they typically want to see 3 open accounts, okay? Probably 2 with 12-month history and 1 with 24-month history. Because most conventional loans are not insured by the government. So they're a little bit more risky. That's why you got to put more money down on most conventional loans. Okay? So hopefully I answered your question. If you already have the high credit and you already have at least 2 open accounts, there's technically no need to go open another one, especially if you're buying a home, because we just talked about it. What happens when you go and open another account? It drops your average down. Now, my average is 4 years. A year ago, it was probably 3 years, okay? Now, I was in a dilemma. I had a house right down the street. I lived there for 13 years over here in Northgate Crossing or about Old Town Spring. But all this COVID craziness happened, right? Plus, I have 2 little kids. I about, my firstborn will be 4 years old next week on Sunday. And I found myself like, you know what? I'm paying $550 a month for this HOA. They even got a playground. So my kids, what are they gonna do? Run in the street, play football? So I said, you know what? I need to go to a different neighborhood. They got parks. So the issue that I had was this, obviously you're gonna try to get another house. They look at your debt, I already had that mortgage payment. So I said, let me refinance that house after 13 years. So at least I could drive my monthly payment down, the debt on because I didn't want to sell my house, right? I want to turn it into an investment property, right? So I had a decision to make. If I refinance this house after 13 years and start a brand new loan over again, I will lose a 13-year account. And my credit score will drop. But it was a catch-22. I had no choice. So I refinanced, credit dropped. Remember I told you I was about to get another house in Montgomery, right? So that's a brand new loan, right? So my credit got hit twice. We're doing what? Trying to bless my family. See? So I don't know. I don't think it's fair, but I'm not the government. I can't make the rules. But that's how that one works, okay? So the length of credit history, that's 15% of 530. That's a maximum of almost 80 points. Do not close or open anything if you're thinking about buying a home, probably in the next 12 months. We will sit down with you and go through everything on your credit report and say, do this and don't do that, right? It might be something like, well, they ran a promotion at the mall for this store that probably I'm going to buy something once every 5 years, right? And you've only had it for 2 months. That might be one that we say, close that one because it dragged you down. Now, if you close it, probably your scores go back up, right? Because a lot of people do that. Hey, if you fill out this application for a credit card, we're going to give you a free balloon, right? And then they just drag your credit down. Now you can't get a house because what? You want a free balloon, right? Okay.
Corey, one of the questions I got this week from somebody is they owed $15,000 on their car. She was gonna put $10,000 on the car, okay? But that's not gonna help her purchase a home because the car payment's gonna stay the same.
That is true.
So paying down on a car will not help you with your DTI.
Yeah.
So I had to explain that to her.
Yep.
It's an installment loan, that payment stays the same for the length of the loan.
Yeah. So if you got money that you want to make your credit better by getting a house, put it on the credit cards first. Let your scores go up. Because when your scores go up, interest rates go down. And that's one of the quickest ways to help your debt to income ratio because it lowers your housing payment. See? So it's either you lower your housing payment or you lower the other debt that's on your credit report, right? So the best way to do it is to pay down the revolving credit. Okay. All right. Number 4. Okay, we got another question. If you guys just showed up, we got people on Zoom here. So I'm looking at the people on Zoom. So it says, let me see, can you pay off charge-offs and collections to improve your credit report? Very good question, right? What's the difference between a collection and a charge-off? He gonna give you $1,000 for answer right.
So I go to some like final election.
I like how you use the head maneuver. Let me tell you the difference. I like giving like parables, right? And examples. So, when you go to Best Buy, I know you went, you get the card, and you got the people, I think they wear the yellow shirts now, right? They've been changing the color of shirts, but the yellow shirts is what they call the loss prevention. That's why they stand at the door, make sure, hey, you pay for that, right? They catch the thieves, right? So Best Buy, and I'm saying this because I used to work with them when I got laid off like 2 decades ago. Nobody gave me a job except for Best Buy. So with these big companies, they know for a fact that they're going to lose millions of dollars a year because of theft, right? So if they lose $5 million in theft, they can report that on their taxes as a loss, which means they don't have to pay the tax on the $5 million worth of product, right? So when a company, you owe them money for for example, $1,000, right? And they've made a decision. We ain't never gonna get that money back. They can write that off on their taxes as a loss. So a charge-off is, it was a collection that they couldn't collect, or they had, we ain't gonna ever get the money back. So they write it off. Now, the way that FHA looks at that is, is if it says charge off, then most likely in our state, they're probably not going to go and sue you for something they already took the financial benefit of writing it off. So they don't look at charge offs as hard as they do collections. So to answer your question, if it's a charge off, do not pay it, because if you do, it's going to re-age the account, right? You remember, after 7 years, negative credit falls off. What triggers the 7 years? The last time an account has activity on it. And if you make a payment, you just started the 7 years all over again. So if it's a charge off, do not touch it. Now, if it's a collection, right? You are a credit enhancement program. We know, because the law says, that a collection can't be reported unless it's 100% accurate. The data became a collection, a balance on the collection. There's so many things that can be challenged, right? And sometimes one collection gets sold to another collection company, and by the time it went through 5 people's hands, it's like, hey, I only owe Sprint $200. Now I owe $1,000. How did that happen, right? So with a collection, challenge the legitimacy of it first, right? You can still get a loan with collections, right? There's nothing that says you can't get a loan with collections. The problem is, if they're recent collections, guess what they did? They dropped your score down. If it's a collection 5 years ago, it's not really affecting your score that much. That falls into this one. How you pay your bills. How you pay your bills more recently helps or hurts you the most, right? If, for example, you had a car that you paid off 5 years ago and you paid on time for 5 years, do you think you got better credit from that old car from 5 years ago or the car that you're currently paying right now? So if it's good activity, more current, it helps boost your score higher. Same thing with negative. If you get a collection that happened last month, you probably dropped about 30 to 40 points. But if it happened 5 years ago, you may only have like a 5-point drop. Because the older it gets, your scores go up. And then eventually after 7 years, what happens? It drops off unless they resell it, right? You got to even challenge that. Hey, this debt was 19 years ago, but it keeps popping up. So challenge it first for the validity of it. And then if it's found to be accurate, you still may not have to do anything with it, right? So what we recommend, get with us. We understand the Federal Credit Reporting Act, which governs collection companies and credit scoring. And we know the guidelines of mortgages. I would never tell someone, just pay everything off and come back when you're done, right? Because what will happen is they will find out, wait a minute, I didn't have to pay that off. And because I gave my money to the collection companies, now I don't have down payment, right? You'd be so bad.
I tell everybody that comes in my program, don't pay anything, let me just do the first, and then we will look at the end if we need to deal with it.
Yep. So did we answer that question? All right, good. All right. Where we at? Mix of credit, 10%, which is what, 53 points. Mix of credit. I call this diversify my portfolio. You got credit cards, you got car loans, you got student loans, you got mortgages. When you see people that typically have 800 credit scores, right? It's either people that had 1 or 2 credit cards for like 20 years, or you have people that have mortgages and they probably had them 4, 5, 6 years. But the thing is when that mortgage account hits that credit report, because think about it, what's more of a risk, a mortgage payment or a car payment? What's more risky, a car payment or a credit card? Car, right? Because the car, right, is a bigger payment, and the credit card, right, like if you charge it up, what can they get back if you don't pay them, right? So the thing is, there's different level of risk based on the factor, okay? But the thing is, you do want to have a mix of credit. So if you say, I only have a car payment, but then you go and get a credit card, theoretically, you will be tapping in to this 53 points. Now, I haven't cracked the code. If you say, well, what if I add a mortgage? What is it going to do? What if I add a car? I haven't cracked that code yet. That's the only one I haven't cracked. Okay. Now, number 5, credit increase. This one is different than all the other ones. Why? Because credit increase, they take away from your credit points. But if you had no credit increase, it's by grace. Grace means to give something freely without having to work for it or earn it, right? You automatically get 53 points. Okay? Now, on my Credit Karma, I had two rates, credit increase and then my age, right? And you would think if I had 4 years and 2 months average age of all my debts on my report, that'd probably be good. No, the highest is when you get 9 years. So I'm still lagging in that. Now, credit increase. This is based on someone that's getting their credit ran over and over and over again. Credit increase will stay on your credit report for how many months? 24 months, 2 years, same thing, right? Now, the reason I can never get that one in the green is because I own a mortgage company. And by law, the federal government has to check my credit every year when I renew my license, times 3 states, right? So yeah, they keep hitting me. I can never get those off. And then again, I did, refinance the house and I bought another one. So those inquiries stay on for 24 months. Okay. So the best place to probably be is in the last 24 months, probably have no more than about 3 inquiries on your credit report. If you do go shopping for a car at one of these mom and pop dealerships where their finance department is a broker, which means they're going to send your data to a bunch of companies and they all run your credit. And that's when you see 15 inquiries, right? It's because they're a broker and they're just shooting all your information all over the place, right? So those could be disputable items because number one, they never told you that 15 different people are going to pull your credit. It's not like Ford Motor Credit. You go in and then Ford pulls your credit, but they're not giving your information to 15 other people. Okay. All right. So in a perfect world, if you were to maximize every single one of these, you would get 530 points and you would be at the top of the scale. But it's not a perfect world because where people struggle, number one, is limited credit history because you can't max that out until you have an average of 9 years. So we're talking about having credit cards, all your cards open for 9 years, probably having a house that's more than 9 years, right? Nobody gets a car loan for 9 years. So that's really what jacks us up because there's no such thing as a 9-year car payment, right? I think the most you could do maybe 6 years. So if you keep financing cars, you're never going to get a car that's 9 years on the books. So that one is very difficult. I've never seen anybody fully max out that. Okay. Anybody have any questions on credit?
I have a question about if you're trying to get not a conventional loan, but let's talk conventional loan. If you're trying to get a conventional loan based on the market right now, what's the credit score that you need to get the best rate?
Okay, you're trying to jump ahead to topic number 2.
I'm sorry.
Right? And she's trying to trick me. Remember, I'm holding back the actual score that you need, right? So she's trying to get out of me, And I was about to tell you anyway. So because we just talked about credit and the next topic is mortgage. So we asked the question, what is the credit score you need to get what? I said it twice already. A good loan, right? Not every loan's good, right? Come on now. Not every loan is good. My definition of a good loan is a loan that takes the least amount of money out of your pocket today, which is down payment, right? But also takes the least amount of money out of my pocket over the term of the loan, 15-year loan, 10-year, 20, 30, whatever, right? Which means low interest rate, right? A loan with the least amount of down and a loan with the lowest rate. Now, there's people that will argue against my way of thinking, right? And they'll say, well, you need to put as much money as you can down on a house. How many people have told you that? Don't get a house until you can put 20% down, right? That's their way of thinking, right? So I'm a basic math guy. And I served in the Navy, nuclear power submarines. I was an electronic technician. So I like simple math, right? Plus, I got experience. Anybody was alive during the housing bubble crisis, crash, fallout, bailout, right? You guys remember that, right? So here's the thing. I've been in this industry long enough to know that if you put all your cash in a house, in the market terms, it's like a stock, right? You put all your money in a stock and then it dropped 50%. Anybody losing any money right now in the stock market? You know what I'm talking about, right? You probably think I shouldn't put all my money in there, right? See, you go and put that 20% down, like in 2006 and 2007. I just tell you, I had some townhomes that I bought from Lennar Home. It was building out neighborhoods right off of 1960 and TC Jester. And anytime the builder has leftover homes that they're trying to get rid of, I come in and say, hey, I'll give you like 20,000 off the price and I'll buy it right now, right? And I'll finance it. So, but I wasn't stupid enough to put a bunch of money down. I just put the bare minimum. So these townhomes that were selling for 125, I picked up for about maybe 110, 115. 2 years later, they were worth $50,000. Could you imagine if I would have put 20% down on these? I would have lost every single dime that I would put in that property. And I couldn't, how can you sell a house that you owe 115 and it's worth 50? You can't. That's why a lot of people got broke very quick. That was gobbling up a bunch of these houses. So the thing is, me personally, I'm never going to put a lot of money down on the house. I will put the bare minimum that the bank says, right? Because you can't predict the future. Anybody can predict it's going to rain tomorrow. Even if Google says it's not, it probably still could rain, right? So the least amount of money out of your pocket today and the least amount over the term of the loan. What type of credit score do you have to have? It's a trick question. Because why? There's 4 different types of loans. VA, FHA, VA for military folks. FHA typically is for first-time buyers. Now, when I say that, it's not because you don't have experience buying. It's typically you're looking for a starter home. And that FHA loan has a limit of how much you can borrow. It has nothing to do with your income, has nothing to do with your experience, but it's a lower limit versus VA loans and conventional loans. Now, they just changed the limit. It was like 340 last year. I think it might be up to like 400,000 this year or something. But most first-time home buyers ain't buying no house for $400,000, at least in this market. And we got people in other states that are watching, right? In West Virginia, probably it'd be 400,000. So, and in Florida, probably 500,000 for a starter home. So we're still blessed in Texas. Good affordable prices. So the thing is, with FHA, as you mentioned, you can get a house at a 580. But what if I told you on FHA, you can get a house with a 0 credit score? There's certain people that just don't believe in credit, right? And we know the government, you can't discriminate, right? There's people that say, I will never put anything on credit. But they pay their cell phone on time, they pay their utilities on time, they pay their rent on time, right? So that's someone that we call an alternative credit buyer. If we can get proof from at least 2 to 3 different companies that they've been making payments, right? Let's say they went to a small mom and pop dealership and they're just paying in cash and it don't report to their credit, right? We can get that type of letter. Let's say that they bought something from a pawn shop and they're making payments for the next 2 years. We can get a letter. And as a mortgage company, we can get that added on to the credit report just so the bank can see there is some stuff that they have as credit, but it just doesn't calculate in the credit score, right? So FHA, you technically don't even have a credit score. So where did the 580 come from? This, when you go to banks, right? They have what's called overlays. This is what the government says, but this is what we're going to say, because who do you get the money from? The bank. When you default, the insurance you've been paying on FHA, there's a particular insurance called mortgage insurance protection. It's insurance that you pay in your monthly payment that if you default, then the government will issue that money to the bank for their loss because you default and was upside down, right? So on FHA, if a bank's guideline is 580 is the score that we require, even though the government says that it's not credit score driven. At a 580, you will get a harsh interest rate. So with us, because we have the mortgage company and we work with 9 different multi-billion-dollar banks, they each got their own rules, right? But what we do know is pretty standard, is if you have a 640, that's where the biggest break in the interest rate comes. So if someone says, well, I got a 740 credit score, right? Well, that's great because you're only going to get maybe 0.25 better than the guy with the 640. The biggest break comes at a 640. And that break typically is about a 1% break over someone who ain't got a 640. And then the next break is a 660. You might get 0.18. And then the next break is going to be 700. Remember the difference of a 0.25%? So you ain't gotta have, who says 740? And then when y'all keep 740, you ain't gotta have 740. If you try to wait to get a 740, mathematically, I showed you, it's kind of rigged against you on some of those factors. You might be waiting a long time to get that 740. By that time, house went up and interest rates went up. Okay, so it ain't a big difference between a 640 and a 7040. But also, when you do apply for a mortgage, you think it's a human being saying, let me look at your credit report. You know what? I think you're going to be good. I'm going to give you, there you go. You're good. No, it's a computer algorithm, right? The government sets certain standards and they have a software that we're connected to. So once we put your information, it pulls your credit, it looks at your job history, it looks at how much money you have in your bank account, your 401k account, and it's an algorithm. And what we're waiting for that software to say is automated accept, which means, oh yeah, you're good to go. Any bank's going to be able to give you a loan because why? We know it's going to be insured by the government because it's an automatic accept, right? So at a 640, you have excellent odds of getting approved for a loan. Kind of like when you look at Credit Karma, right? And it says you have an excellent odds of getting this credit card, right? Because it's an algorithm, you see? So that's how the credit scoring, the most important part of credit scoring is when that data goes in to that automated underwriting system. The abbreviation is AUS. If you want to write that down. AUS, Automated Underwriting System. That's the software. That's the term for the software. And when it's going to crank out to be favorable is an automated accept. Now, if it says refer with caution, blinker light. Be careful, be careful, be careful. The person at the bank called the underwriter could do what's called a manual underwriting. Write that term down.
What was the AUS?
Automated Underwriting System. AUS, Automated Underwriting System.
And then the manual.
Manual underwrite is when you don't get the automated approval, and a human being, which is called an underwriter, has to make a human decision. The problem with that is most humans don't want to make that decision to give you the loan because in the event you default, that bank has to buy that loan back. Because most banks will do the loan and they sell it to larger banks or larger entities like Fannie Mae, Freddie Mac. So if they find out that you took a risk and it was a bad loan, then they got to buy that loan back and try to service it for 30 years. Most banks are not servicing companies. Most banks cannot carry your loan for the next 30 years because they don't have the billions of dollars to have 1 million customers paying mortgages. So what they do is they give you the money that they have to buy the home, and then they turn around and sell it to a larger bank who can service it, like the Chase banks and the Banks of America, the humongous giant banks, right? Okay? Does that make sense? So when people say, what is the score that we need? If you're getting FHA and VA and USDA, remember we talked about if you want to live in a country, that's a no money down loan, right? Rural loans, less than 10,000 residents of an area. Those are government insured loans. 640 is the magic number for them. If you're going to go conventional, and there are some conventional that are partially government funded, right? But for most mainstream conventional loans, I would probably say if you're below a 660, you're going to have a hard time getting approved. And you're going to get jacked on the rate. So for conventional, we say above 660, right? Because they're not government insured, and you're going to have what's called PMI, private mortgage insurance, which are companies that are not connected to the government, that you're going to be paying a monthly fee to them to protect the bank in case you default on those loans.
Sorry, how hard was it for you to get the second mortgage when you had the first one?
It was playing with numbers, right? It's being able to qualify with the debts. Question.
Is it worth it, in your experience, to buy down your interest rate?
To buy down your interest rate. She said, is it worth it to buy down your interest rate? It's based on a couple of factors. If you say, I will only buy a home if my payment is exactly 1,500.00, not even a penny more, right? If you're that type of person, then yes, we might have to do something to buy the rate down so that you don't have a payment of 1,501, right? So there's a problem with buying down. Anybody heard that before, buying down an interest rate? When you have money, right, there's two things you can do with it. Buy the rate down or put the money down. So let me explain the difference. When you buy the rate down, it's because you want to get a lower payment. But really what you're doing is you're prepaying the interest that you would have paid. So let's say you spend $6,000 to buy the rate down, 0.25%. And now you're saving $20 to $30 a month. But then 2 years from now, you sell your house. Did you really make back your $6,000? She only saved like $20, $30 a month times 12 months. So really that comes out to be like $340 per year. How long would it take you to have a big enough savings to get that $6,000 back? Most people don't even stay in the house that long. So that's why I'm saying that people that want to really do it and it don't make sense because it says, I only want a payment, an even payment, right? Okay, if that's what it takes, you got to buy the rate down. And they'll spend thousands of dollars just so they don't have that penny over what they want. Now, if you have that $10,000 instead of buying the rate down, you put the money down. And then you say 2 years from now, I want to sell it. You get your money back. Because what you did was you got more equity in your house.
Yeah.
Does it make sense?
Yeah.
So the thing is, buying rate down, yes, people sometimes, and again, if you've got 10,000, it might be better to put it down versus buying the rate down because sometimes people do it, it's because their debt to income ratio is off, right? You know how when you get an apartment and the rent is $1,000 a month, right? How much income do you have to make gross? 3 times, right? So there's a ratio in that particular situation. That's a 33.3333% ratio, right? It's the same thing with housing, except that ratio can be a little bit higher. So for example, in FHA, you probably can, with excellent credit, get away with a 54.1, for example, right? So let's say you're at 55%. And you're like, how can I get that ratio under 52? You could put the money down or you could buy the rate down, right? Those are the two ways. Because at the end of the day, what's happening in that ratio, a big portion is your house payment, and it's about lowering that payment. Okay? So people can buy the rate down, but honestly, it's based on where you see yourself in the future. Okay? And we'll advise you on that because we don't like people wasting their money. Because you work hard for the money, right? Did I make a song about that? Work hard for my money? Okay. All right, so we are already talking about stuff in the second topic, mortgage financing. I always tell people that financing is what sells homes. Because isn't it true when you go buy that car and the car costs like $40,000 for a car, right? And they're like, we know it's expensive, but what's the monthly payment that if we give you, it'll make you happy and you'll buy this car, right? Isn't it true? You'll say, well, if it's $450 or less, right? So then you don't focus on the price of it anymore. You focus on the monthly payment, right? And then they do like a little, it's like a little square, right? What's more important, the payment, the interest rate, the down payment? So that's why I say people buy homes based on financing. If you can meet their budget for that house that they want, most likely they're going to probably buy it. So mortgage financing to me, and I already said credit was the most important one because that determines what type of financing. So I had to say it's the second most important of the financing. Yeah, he sounds speaking too fast. Okay. Who's doing the translation anyway? Eddie? Okay. I forgot about that. Hard on me. Okay. So we've talked about credit score, right? What a bank's going to look for, because it says right here, what do banks look at in order to approve you for a loan? We talked about credit score. Okay. Now let's talk about income, because this is also an area that a lot of people get confused with. So let's talk about types of income first. Now, it's either your W-2 employee, right? Which means you get probably a salary. It could be like getting extra money for working overtime. It could be you got commissions, you got bonuses and things like that. But you work for someone that's writing you a check or doing the direct deposit. So that's one way of getting paid. Anybody know another way? Any self-employed people in here? 1099 contractors, business owners? It's where you're pretty much on your own. If you don't work, you don't get paid, and it's all up to you, right? So self-employed people, the banks look at their income differently than W-2 people, okay? So W-2 people, just like how apartments look at, they go by your gross. So if you make $5,000 a month, you probably ain't getting $5,000 in your bank account. You probably get like $3,900. Because wow, they take the healthcare and all this other stuff, taxes, right? I honestly don't even know what they do with this money, right? So they look at your gross. They look at the 5,000. If you're self-employed, for example, like a real estate agent can be self-employed, right? The person that does nails, they self-employed. They're gonna look at their tax returns over the last 2 years, right? And based on if they say they made $50,000 a year, every year, they're gonna add those 2 years up. They make $100,000, right? And then they're gonna divide it by 24 months, right? So after they have their expenses, let's say their 50,000 really was 25,000. Then they're gonna add the 25 plus the 25,000. That's 50,000 over 24 months, and then they're gonna divide that by 12. So it's after the expenses is what they're gonna look at. But for W-2 people, it's before all those expenses came out. That's why we say, if you're gonna buy a home and you're like, I'm gonna become self-employed, or my boss convinced me to be a 1099 contractor, don't do it. Because now you gotta work 2 years being self-employed before now you can apply for a house. Okay? There is one other way. It's called a bank statement loan, but you're gonna get gouged with 10% down and a high interest rate, right? But we don't want you guys to get that type of loan. We want you to still qualify for like the FHAs and the regular type of loan, okay? So those are the 2 types of positions. What's that?
If you are self-employed, say for the last 5 years,
Okay,
but you consistently have loss. So like you really didn't get profit.
okay. So your question is, what if you're self-employed for the last 5 years and every year you took a loss, right? Because when you take a loss, you ain't gotta pay taxes, right?
Well, yeah,
So that's why a lot of people take a loss.
yeah.
So the thing is, if you have a negative number, then guess what? They add up the negative numbers and you equal negative income. So you don't make any money to qualify.
Okay.
Yeah.
I'm just saying,
So if you're gonna start a business, remember, you don't start a business to be in a loss.
Yeah.
You shouldn't do that, right? You should be doing it because you wanna make more money than probably what you could being a W-2 employee, working somewhere else, okay? And there's other benefits, the freedom of life, making your own work hours and things like that. So those are the 2 types of ways that people get paid. Now, let's talk about W-2. If you are getting bonuses and commissions, because those are not guaranteed, right? Most bonus and commissions are based on sales, right? Or productivity. And we know sometimes productivity goes up and down. Sometimes productivity is seasonal based. We know that people that are in sales typically make more money during the holidays, right? So if you're that type of person who's getting an hourly wage or a base salary plus bonus and commissions, we got to average those bonuses and commissions over the last 2 years to count it. So we separate your base salary or your hourly rate, right? And we come up with the monthly income, but then we have to average your bonuses and commissions. That makes sense? Because the income fluctuates.
That's for, because I mean, that's what I get paid salary and commission. So it will be along 2 years.
You gotta have 2 years. We average it. Now, if you make overtime, right? Is overtime always guaranteed? Not always, unless you're in nursing, right? Because sometimes they have to work more than 40 hours based on their shift work, right? So if you're not like that person who's guaranteed that to keep your job, you have to work overtime, just a regular person that says, hey, we need you this week to work a couple more hours. Then what we got to do is even average your overtime over the last 2 years. Any pay that's not guaranteed that fluctuates, we got to do an average. Make sense? Okay. Now, let's talk about some incomes that you can count. If you get child support and you can prove you're going to get it for the next 3 years. Sometimes people say, well, I'm getting child support and my son is, I don't know, 17. You might say, well, you technically not going to get it. But if you go to college and a court decree says the other person got to pay up until they graduate college or whatever, as long as you stay in college, then you might be able to count it. Social Security income, disability income, military veterans, disability income, right? Retirement income. Let's say that you're an heir of someone that has oil in the ground and you get a royalty of $500 a month and you show proof that you've been getting it, right? And until you sell it, you probably will continue to get it. They just do the average of what you've been getting for the last 2 years because even the oil royalties can go up and down, okay? Money that you're getting off your stocks and bonds. Let's say that every year you make like $2,000 a year based off of your investments, right? You can also get credit for that type of thing. You just got to prove that you've been getting it and that you're going to continue to receive it. Does that make sense? Okay. All right. Question?
I'm just looking at the work history, right? You say 2 years with the same occupation, because I'm looking to change my position, like, within the next 2 weeks.
Okay, the key word is occupation, right? So when it comes to work history, number one, you got to have a job when you apply for a loan and when you close, right? That's got to. Can't pay a mortgage if you ain't got a job. Number two, they do want to see that you have 2-year work history, typically evidenced by your tax returns. It's okay if you work for different companies, especially when COVID, people were bouncing around from job to job because, you know, the situation, right? So it's okay if you go from one job to another. But here's the thing. Someone is, I don't know, in nursing for 5 years. And then all of a sudden, they just say, I want to fix computers for the rest of my life. 2 totally different occupations, right? That's scary to see someone do that. So they might say that you need to have 2 years experience working in computers because you just totally change your occupation. Now, let's say that you're a nurse and you're working at a hospital. And all of a sudden, you get a position to be the school nurse. Different industries, working in a medical hospital versus working at a school district, right? Getting paid by the, HISD, but you're still technically a nurse, right? Same thing as a nurse who's fixing people up in a hospital and then becomes a research nurse, which you're like more like an educator now. So if you're in the same line of work, then you're not gonna have an issue. In my situation, when I bought my first house way back in the day, I was leaving the military. I was a military recruiter, so I was in sales. And then once I got out the military, I became what's called an executive headhunter for a company in Houston, where I would recruit people out of the military that had certain backgrounds and help them to find jobs in the Houston area. So I was still a recruiter, I was just doing it in reverse, right? But I left the military and worked as a civilian, as my occupation. So they gave me credit because I can explain to them that I'm still a salesperson and I'm still helping people to get jobs, okay? It's called a letter of explanation when they say, hey, why the change? And then we just got to explain it to them, okay? Now, rental history. Now, let me back up. Remember, we talked about the 2 years of having a job. If you went to school, right, and you're like, I want to make sure I got a 4.0 GPA, so I'm not trying to work, I'm a full-time student. As long as you show proof that you graduated, you got your certificate or degree, then they can waive your work history. Yeah. So if you went into a 2-year, nursing program and you graduated and they're like, well, you haven't worked for 2 years, everybody's gonna be fighting for nurses out here, right? So all you gotta do is show proof of a salary letter or hire letter. You're good to go. Yeah. Here's the other thing. A lot of people will do this. I'm gonna buy a home. I want to get more money for down payment. And I want to have more income to qualify for more of a home. So they go get a part-time job. Think about it. They only got the part-time just to get the house. Can they sustain that for 30 years? No. So if you have part-time income, they will not count that for the purchase of the home unless you prove you've been doing it already for 2 years. Now you can go get it to save the money for the down payment, but you can't use that additional income for qualifying purposes. Okay. Another thing, and this is happening a lot. Everybody knows prices are going up, right? And with the pandemic, a lot of people was out of jobs. So what families did was they started coming together and living in the same roof, under the same roof, right? So, and once you're in that situation, for example, let's say mom got laid off and she had to come and live with you in your apartment, right? And you're like, you know what? It's my mom. I got to take care of my mom. And now you're so used to having mom around, especially when you got kids, you get free babysitter like I do. So my mother-in-law, they all live with me now, right? So the thing is, you can have multiple people on the loan with you. So a lot of people are doing this. They're living like in a 1,300 square foot apartment, if they're lucky to find a 1,300 square foot, right? And they're like, well, wait a minute, the rent's going up. We're going to be have to pay like $1,500 to $2,000 a month. Why can't we take mom's Social Security, dad's Social Security? You know, my son's 19 years old, got a job because he didn't want to go to college. So he's making a couple of dollars a month. Why can't we add up all the income and then go get us a 2,800 square foot home, 5 bedroom, 3.5 bath in a nice neighborhood and still pay $2,000, $2,300 a month? A lot of people are doing that. It ain't no different than when you buy a car and you have to co-sign for something, right? See, even when you get a house, if there's someone, and it don't even have to be your family, that's the thing. But let's say I have a situation right now. I got a young man, he lives in Dallas, right? His mom had a big old house and all her sons ran away. They got good jobs, so they left the area. So she sold the house and has been renting. And she's like, I don't want to be in an apartment. Just let me get a little bitty house. But the thing is, she's retired. She don't make a lot of money. And she does taxes when tax season. So she'll make a little bit of money on tax season. So her son that lives in Dallas, he's co-signing using his income to help his mom to be able to qualify. You know, and she's got a little bit of down payment because she sold her house about a year ago. So sometimes we do see where parents help their kids, but also sometimes we see the kids help their parents. Yeah, especially if you are a single mom and you only got one kid, right? Who's the house going to go to anyways? It's easier when the kid is actually on the deed with you. See? So you got to be creative because house prices are going up, right? And rents are going up, you know? So you got to figure a way to get into your house now because, you know, you might not be able to get in 5 years from now. Okay.
House prices going up, so do you not believe that a buyer's market is going to come back around at some point?
So pricing is always geographical, right? If you're looking on the south side, the Pearlands, the Sugarland, the Rosenbergs, right? They've never really been areas where there was a lot of houses anyways, right? So those houses, they shrunk up the inventory. Those prices went up even higher down there. Up on the north side and even out on the west side. Katy, Fulshire, Brookshire, you know, that Grand Parkway 99 area, there's still a lot of opportunity because there's still a lot of land, right? When there's people that are like, I ain't selling my home because we don't know what COVID's going to do, right? There's people that just don't want to sell their home. They're like, you know what? I ain't trying to sell my home no matter how much money I can get because the economy, right? So that's why there's a shortage of homes. When there's a shortage of homes, that drives prices up. But in areas where there's a lot of home building and they're cranking out, let's say 1,000 homes in the next 12 months, the price is a little bit more stable. Like right around this area, spring prices are still good, right? You know, you got Montgomery, Magnolia, Tomball, Humble, Porter, which is right down here off the Grand Parkway. So most people also are jumping ship from the city and they're going rural and finding great deals. And the reason they're doing it is when COVID happened and the government in Harris County said, y'all can't go to work, right? No more than 10 people. If you had a company more than 10 people, how are you going to come to work? Praise God, we in Montgomery County with this building, literally spring, but we're right here on the Montgomery County line. So we was able to still stay open. But a lot of people, they say, go home and work from your house or your apartment, right? So now the company's like, I've been working from home for 2 years. Why don't you stay home? Oh, really? Okay, now I can buy a house in Willis or Lake Livingston and look at a pretty lake while I'm, stressed out of my job. So a lot of our clients are like, listen, just show me where the taxes are cheap, where the prices are more affordable, and the scenery is a lot better, so I ain't gotta look at this all day long.
Right?
You'd be surprised how many people are going rural. Yeah. And I went rural. It is. Yeah. The main thing is cheaper. And it's not, you just can't look at the price of the house. You gotta look at the property tax rate. I have a house over here in Springs, the property tax is 3.4. I move out to Montgomery, the tax is 2.8 before homestead.
Yeah.
So the house costs more, but I pay more taxes on the house down the street. And that taxes is part of your monthly payments, is what I'm saying. So you can afford more when the taxes are lower. Okay? It's all about math. You gotta know the math. All right, so we talked about the work history, rental history. The number one thing that's most similar to a mortgage payment is what? Rent. So if you have been struggling with paying your rent, do you really think a bank's going to give you a mortgage loan? No. For your rent, the last 12 months have no late payments. Now, we got to submit documentation to your landlord. It's called a verification of rent, right? And they're going to tell us when you moved in, how much and how you paid. And if they say that you've been late on your rent, this is going to automatically disqualify you. Okay?
What if you live with family?
Good question. Good question. Now, whose mama won't lie for Mine won't. She's a Jehovah's Witness, right? And she ain't trying to go to hell. You know the Bible says, no liars, thieves, go. So enter the kingdom of God. So here's the thing. If it's a family member or just some guy named Joe who's not a company, right? When you get in these loans, they're not going to believe what these people say, because you could be renting from a guy named Joe and horrible paying your rent, and he'll say whatever it takes to get you out of his place, right? You could just say, Mama, I'll just give you a couple $100 for groceries, right? Now, can you sign this and say that I've been paying you rent? And oh yeah, you pay rent. They'll put $300, not grocery money, right? So you do not want to commit loan fraud, because what? $10,000 fine and 10 years in the prison. Right? And I ain't trying to go to prison for nobody, no. So when it comes to living with family members, or you're paying rent to a non-company, right? Like if you're in an apartment, you pay it to a company. If you rent it from a guy named Joe and he has a property management company that's collecting it, then it's a company. So the way around it is, every time you make your payment, you should write a check and write the word rent and give it at the same time on the, typically due on the 1st, late by the 3rd or 5th, right? Make that check go through the same. You can do a transfer from your bank, because then they can say, let's look at your last 10 or last 12 months of bank statements and see that rental payment came out. As long as you have a paper trail showing that you make the housing payment. Because if it's a family member who would not lie for you, right? They would lie, right? So they're not going to trust them. Okay? And if you say, well, I made a deal, well, my job is to pay the electric, right? Just switch the deal. See, you can still, they can use the money whatever way they want, right? But just say, I'm going to give you a check and it's going to say rent, and I'll put it in your bank account. If you want to use it for electricity, that's your thing.
And how long are they going to look for you?
12 months. You got to have 12 months rental history.
So I'll just write a check for like any amount.
Oh, whatever you agree to pay your mom or whoever.
I was just saying, like, so I'll do that for 12 months.
Yeah.
And I can show that to whoever I'm purchasing a home from.
We're going to turn it to the bank, because that's one of the guidelines for qualifying, is you have to have 12 months good rental history. So if you have a printout of the canceled checks, when someone cashes a check, you get a printout, right? You either turn in 12 canceled checks, or if you just do the transfer from your bank to their bank, we need the last 12 months of bank statements. Okay. Now, again, if you're going to college, you might say, well, I lived in a dorm and I live for free. There's always circumstances like that we can get around. And it's through what? A letter of explanation. I don't have rental history because I was in college living in a dorm, right? Like, think about it, if you're in the military, don't they pay your rent for you? They give you a stipend, right? So of course you're gonna be paying on time because they give you the money just particularly for that. So, but the thing is, there are certain circumstances that we could probably get around. And here's the other thing, the higher your credit and the lower your debt to income, you could have leniency. Banks will be lenient in certain other areas, right? It's called compensating factors, right? So we just got to look at the big picture. Okay, the other last red bullet point is the ability to save money, which is called reserves. Money that you have stashed away, not under your pillow, in a bank account, 401k, right? Stocks, mutuals, things like that. Anywhere where the money can be turned liquid. Now, when you move into your house, it makes the bank nervous if you're going to move in and have zero money to your name. They know there's costs associated with maintaining a house, right? Like just changing out filters every 90 days probably will run you about $30. So it looks favorable in the AUS. Who remembers what that is? Looking down. She wrote it down. She wrote it down. Automated underwriting system, right? Sometimes you may get the automated underwriting system that says refer with caution, which means you ain't getting approved, right? But then you say, well, wait a minute, this person got a 401k with 15 grand in it. Let me put the 15,000 in the block in the software that says assets. You put the 15 grand in, automatically accept because you got a cushion. So it's very important. And I know a lot of people, it's hard to say, right? Especially with the internet, they keep putting ads in our face, right? And every time I'm gonna buy. And at the end of the month, you bought 15 things. You're like, oh my God, I just spent $1,000 on 15 items, right? So the best way you could probably do it, if you got a job that gives like a 401k or some type of retirement where they can just hold some of that money for you, just have it come off the top. Even if it's like $200 a month. You can't spend it if you don't get access to it, right?
Right.
So then by the time that 401k, 4,000, 5,000, 6,000, it's just a matter of plugging it in to the computer system. You'd be surprised what happens if you have at least 2 months of reserves. Yeah, question. All right. Okay, so paying rent with a money order is kind of like the same thing with a check, right? We can see when you took the money order amount out of your bank account. I would still make a copy of the money order. Now, you typically get the little carbon copy sheet, right?
And then you got a receipt,
Just scan it.
just throw out the receipt that is in the.
Yep, it's a little carbon copy you get, right? So what you do is scan it, right? And then put February rent, January rent, and just keep it scanned. And then what they'll say is, okay, we got these 12 months of scanned money orders, and we got your bank statement, because listen, isn't it true somebody could just walk up and give you $1,000 and you can go buy a money order and just say rent? They want to see it came from you. So they still will ask you for your bank statements to see that you took the $1,000 from your bank, and then it matches up to when you got that money order. The government's very thorough. And banks, they're not trying to get slapped by the government anymore, right? Because of the new, it's not new, it happened when the bailout happened, but it's called the ability to repay. If the government finds out that a bank gave somebody a loan and you knew they didn't have the ability to repay, then you're going. All right? So we don't mess around with that. All right. So it says, how do I choose the right bank or mortgage company? Let me ask this question. What's the difference between a lender and a mortgage broker, which we're a mortgage broker?
Lender is a big bank.
Lender's a big bank? Okay. Anybody else?
Broker funds, right? Like the broker is like the middleman, between
Okay.
the buyer and the bank.
Okay. Look at it this way. The word lender and bank is the same thing. It's somebody that gives you money. I don't have no money to give you, right? But I can find the money. So a mortgage broker is someone who has a company and we do contracts with big lenders, billion-dollar lenders. Now, these lenders are different than the Bank of America, the Chase, the Wells Fargo, and the credit unions. Because those guys, you can see their offices, right? And you can see all the people that work for them. You can see the lights on at night, because they got to pay the electricity. So those are what you call retail banks or lenders. So a wholesale lender is a big bank that doesn't have those storefronts, right? They do got a big corporate building that's probably worth millions of dollars throughout the nation, right? But they don't have the little bitty offices where you can walk in and get a loan. So what they do is they partner with mortgage brokers like ourselves. And what they'll say is, if you find people and you can originate their loan, which means we pull your credit, we run it through the automated underwriting system, we verify the rent, we verify your employment, we verify a lot of stuff. And once we show proof that you are qualified for a loan, FHA, whatever type of loan out there, then these wholesale lenders will say, we would like to issue money to that person, right? And remember, most of these banks are so large that they're the ones that can service your loan for the next 30 years. Okay? That's how big they are. So our model is we pull your credit one time, right? We get the automated approval, and then we shop it around to the banks to see who's going to get you the best deal. Now, here's the thing. The government has certain rules and regulations on mortgage brokers that they don't have on banks. Because banks are very big and powerful and have a lot of money, okay? So the biggest difference is when you go to a bank, they can make money in lots of ways. Loan origination is the cost they charge you just to get that automated accept. The fees that they charge you, processing fees, underwriting fees, but the number one way that they make their money, who knows how? The interest rate, right? They're allowed to get paid off what we call the yield spread. See, if they give you 5%, sometimes they get money somewhere else and they ain't paying 5% for it, right? So they could give you whatever rate you're willing to accept and they can make the difference on that rate. We're not a lender, right? So as a mortgage broker, it's illegal for us to get paid based off of interest rate. So if I have, let's say 9 different banks, and this bank is at 4.9 and this one is 4.5. Before the government cleaned up the industry, a mortgage broker could say, you know what? I'm going to hook you up with 4.9. And the difference of the rates, they would get paid more commissions. That became illegal. Yeah. So that's the main difference is we cannot get paid based off of the interest rate you choose. So think about it. Our business model is let's get you the lowest rate, while the big banks are let's see what rate you're willing to accept based on a snapshot of your credit worthiness, right? And sometimes the banks that we're working with, the big lenders, the wholesale lenders, already their rates are a lot lower because they don't have the overhead that these big banks have, right? They don't have the footprint across America when it comes to buildings, even though they do way more loans than a lot of these banks that you see. So the thing is when we work with these banks, sometimes they may say, we need more loans this month because think about it, they're an empire carrying loans over 30 years. So they have goals and quotas. So if they're not meeting their quota of new loans that they're issuing, and sometimes the government puts a mandate on banks, you have to give out X number of loans to a certain type of demographics as well. So they got quotas even the government puts on. So they might come to us and say, listen, we need more loans. For the next 3 loans that you send our way, we're going to lower the rate by 0.25 or give you a lender credit, which means we're going to help somebody pay for their closing costs. So the thing is, they fight for your business. They reach out to us and say, hey, we have a special incentive. Do you have anybody qualified that we can go ahead and let them borrow money? Okay. So the second regulation that they have on us is how we get paid. There's only 2 ways a mortgage broker can get paid. By you or by the bank, but you can't get paid by both. That was something else they changed more than a decade ago because there was no rule back then. So you would charge somebody the loan origination to do all their loan, get it through the acceptance, but then also the bank would say, hey, because you're sending loans our way, we're going to pay you a commission. So now the government says you have to make a choice. Either charge it to the consumer or you charge it to the bank. Anybody in here got $1 billion? Anyone? All right. So we're not trying to charge it to you. No, we're gonna stick it to the bank because, and honestly, who bailed out the banks? But how the government get the money? Right? So why not stick it to the bank? So we choose to get paid by the bank so that, number one, you don't have to pay for the service, right? Because even if we did charge you to do your loan, doesn't that add to your upfront cost to get in the house? People are already struggling with the down payment, let alone the closing costs. So why would we try to add fees on the people, right? And because we're a real estate company, right, we're trying to help you to buy a home. It goes against us being able to get a contract on a home when you got to come up with an extra $2,000 to $3,000. It don't even make sense. So that's the benefit of having a real estate company and a mortgage company is we can reduce the cost on your loan side to help you on the real estate side. That makes sense? Okay. You guys understand now the difference between a lender and a mortgage broker. Okay. Okay, and we already talked about can you add people to the loan? So I already covered that. Any questions on mortgage finance? Do you think you know a little bit more right now than you did even an hour ago? Is there any question you guys ever had or ever wondered about home loans? What's that?
So I guess at this point, and I hate, if I jump ahead, let me know, but I was wondering about, you just mentioned it, closing costs, down payment. How do you get assistance for those types of things?
Okay.
What's the qualification?
Good question. Good question. So her question is, what was that? You said it's 3 o'clock. Trying to keep me on time. I'm gonna go where the people take me, right? So this is very important, very important. So here's the thing. When you look at buying a home, and if you're in the process, we actually cover this topic. When you're buying a home, there's down payment if a down payment is required. Not every loan requires a down payment. VA, military folks, they don't have to pay a down payment. People that buy rural, they don't have to pay a down payment, right? If you do have to pay a down payment, conventional loans start at 3%, but you can pay 5, 10, 20, 50, whatever you want to pay, right? FHA is 3.5%. That's the down payment part. So let's talk about that part. Down payment is supposed to be paid by the person buying the house. Because why? They want you, when I say they, the government and the banks want you to have skin in the game. It's less likely you walk away from a house when you got $10,000 tied into it, $5,000 tied into it, right? You ain't gonna be like, oh, I don't like this house. Here's the key, bank, I'm out, right? You see? So that's why FHA used to be 3%, but they increased it to 3.5%. Because when it was 3%, the average price of the house, like in this area, was like $100,000, right? So but then prices started going up. So the thing is, down payment, they really want you to pay it because they want you to have skin in the game. Now, are there grants out there to help you with your down payment? Most definitely. But remember, they want you to pay. So here's what they do. We have programs where we can get your down payment on FHA pay, but you're going to take a higher interest rate on your loans. The problem, and they don't tell you this, the problem with that is sometimes these rates can be 1% higher than an FHA loan without the down payment. So now what happens is the 1% higher rate means you qualify for less of a home. So now you got a decision to make. Do you want to settle for a home at a cheaper price just to get in with one of the programs? Or do you want to find a solution to get the down payment, right? So that you can get the house you want. That's the dilemma that our clients always run into. And we let you know up front. Because people will say, my friend did a program and they did. But what they forgot to tell you was they also could have sacrificed the amount they qualified. 10 years ago, it wasn't a problem because houses wasn't that expensive. And rates have been low. Like we've been giving rates out last year in the 2%. Wow. Yeah. And they just started going up. Government said 4 times this year, rates are going to go up. They've already went up twice. And we just barely get out of February, right? So back then, it was okay. It's just now people are like, oh, I want to get that house for $220. But if I get that down payment assisted and I got to get that 4.5 or 4.9, now you're down to about $199,000 house. It may not be based on the area. For sure, it ain't on a Pearland, Sugar Land, right? Missouri City, come on, you ain't get a house for $199. So here's the thing. Down payment can be paid, right, by a lender who has a grant program, by the government who has a grant program, but also it's FHA says you can get it in the form of a gift from a family member. So a lot of times what people will do, hey mom, I'm trying to buy a home. This is the home I want. I could get a grant, but it's going to cost me not to get the house I want. Is there any way you can just give me $1,000, $2,000, right? Hey, I'm gonna have a housewarming party, but instead of bringing me gifts, everybody pitch in, give me a couple $100 right now. And they fill out a form, it's called a gift letter, right? You can do that, okay? That's the way you can do it, okay? Now, if you have a 401k, you can tap in it, education, medical expenses, and buying a house. That's another reason people get it. Now, here's the thing. If you have who got a 401k right now? Are you making money or losing money in the last 60 days? Take that money out, put it in your house. Because what are house prices doing? Going up. I've got people calling me saying, I don't care what house I can get. I lost $50,000 in the last 60 days of my 401k. I will buy any type of house. These are people like from other states, right? Where their house is a lot more expensive. And they're like, hey, I heard Texas, I can get a house for $200,000 and I could go ahead and put 30, 40, 50% down because I got to get it out of my 401k because they're watching it drop. Right? So if you have that 401k and you know I'm telling you the truth because I got some retirement and it is dropping like crazy. I've already lost 25% of my portfolio. Yeah. Dump it into real estate, somewhere in real estate. Okay. Now, that's the down payment part. The closing costs. That'd be like when you buy a car, right? $40,000 car, but you got to pay title, tax, and registration. That's the cost of making the purchase. Your closing costs on an FHA, even VA, could be probably about 3 to 4%. Some states like West Virginia, where taxes are a little bit lower because part of your closing cost is your taxes and also the homeowner's insurance on your house. You got to prepay that stuff up front to make sure that you have enough already in a cushion to pay those debts, like your taxes at the end of the year and the homeowner's insurance every year on the anniversary that you moved in. So on a $200,000 house, your closing costs could be $7,000 to $8,000, right? Now, the rule on closing costs, you can pay it, the lender that you're getting your loan can pay it, and then whoever you're buying your house can pay it. So when working with us, we negotiate with the seller, right? If our client buys your home, we need $3,000 to $4,000, for example, to help them to get in your home. The banks we work with, remember I talked about the special promotions? They might say, well, hey, if you go with us, we're already going to give you $2,000 to $3,000, right? And then you can still get closing costs from family members, right? So closing costs, it is a little bit easier to get paid than the down payment because the down payment, the bank and the government, they want you to have some skin in the game, okay? That makes sense. All right. So the last topic, the home search. That's the part that everybody's like, oh yeah, I'm approved. I don't have to worry about the credit. We go and shop. How many people like shopping? Love shopping, right? So here's the thing. When you go shopping and you've never bought a home before, like how many people went to go buy their first car? Did you go by yourself or did you take somebody with you? Went by yourself? Did you make a good decision?
Oh, with my first car?
Yeah.
I think I did.
By yourself?
And also, when I left to go buy my first car, nobody's gonna give you a car. We're not about to let you get a car. Drove out the lot.
You're proving wrong. Proving wrong.
Proving wrong, yes.
When I bought my first car, I was in the military. I had my uncle in the Marine Corps. He came down to San Diego and said, hey, let me go with you because he sells people to tell you anything, right? So I had somebody that went with me. So when you're buying a home, especially if you're a first-time home buyer, don't you think you should have somebody with you that got experience? Who wants to make a 30-year mistake? Nobody, right? So that's why we're here. We are a real estate company, but more important, we are realtors. Who can tell me the difference between a realtor and a real estate agent?
To do the house, which is what the agent can only show you probably.
Okay, that was a good try. At least you tried, right? Anybody else? What's the difference between a realtor and a real estate agent? Nobody? Okay. Don't worry, nobody ever gets this. So here's the thing. in every state in the United States of America, in order for a person to help another person to buy a home and advise you, right? Because when you advise, you're technically practicing real estate. Would you agree? And to practice real estate without a license is a third-degree felony in the state of Texas. Did you guys know that? So if you say, I'm going to go with my friend and I'm going to advise her, then you know what? If you get caught, you could be going and getting a third-degree felony. Look it up. Illegal practicing of real estate without a license in Texas, third-degree felony. Okay? The other thing is, if you say, I'm going to take someone out there and advise them on buying a house, right? And whoever they buy the house from pays you a commission, you're probably looking at either a felony or at least a misdemeanor, because you cannot receive a commission because you don't have a license. That's called paying a commission to an unlicensed person. Did you guys know that? And I'm telling you because it seems like when we have clients and we're in the field, all of a sudden, the boyfriend shows up, the girlfriend shows up, the aunt shows up, the person from church, shows up, and they're like, oh, you should do this, and you should do that, and you should do this, and you should do that, right? And we gotta say, listen, be quiet, unless you wanna get felony, right? So just be cautious with that. Now, the difference between a real estate agent and a realtor. A real estate agent took some classes, right? Probably went to Champion School of Real Estate, which is local here. Took the classes, passed the classes, and then took a national and state exam, right? And that's what makes them legal to practice real estate because they have a license, right? It's no different than when you see people post on Facebook, this stock is going to do this, 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 and this. And they put not professional advice, right? Because they're not licensed. You go to jail for telling people, hey, you should invest in this. It's illegal, right? Just like someone who says, I'm not a doctor, but you should do this. You practice in medicine without a license. So a licensed person can advise you on real estate matters and receive a commission to do it. Now, the difference between an agent and a realtor is a licensed real estate agent who joins the National Association of Realtors, which is the national. Then each state has a board. Ours is the Texas Association, right? Florida is the Florida Association. And then we have a local level of the board. Look at it as a union, right? We pay dues every year to be part of a union that represents over 1 million realtors, which are real estate licensed people, right? As advocates for us, the industry, and also consumers, okay? And they're very powerful, right? They get to go to Washington, D.C. with all these millions of dollars that they collect from us and tell politicians, housing is going down, it's not affordable, y'all need to come out with programs and do things like that, right? Make the rates go up, make them go down, do whatever it takes so that people can still have homes, okay? So a realtor is someone who is part of this great union, but also we have our own laws and regulations within the union. So it's double jeopardy. There's certain things, state law you do, you get busted by the state, lose your license and pay fines. But then when you join the Realtor Association, we have a code of conduct that also we can be busted if we did something to violate that. Okay, it's kind of like double jeopardy, right? So, but regardless, we are a realtor company, and when your company is a member, then every licensed person within your company by default has to be a member, or they can't be part of your company. Okay. Now, let's talk about working with the realtor, real estate agent, right? How do we find the right home? Now, this is something that in this type of market, it is challenging. I'll be honest, y'all see the news just like I do, right? It's challenging because people know what they want, but sometimes they got to settle for what they need, right? There's a lot of stuff we all want in life. Can we honestly say we got all of it? But there's one thing I do know is you either sleep on the street or you get to sleep under a roof, right? And if you sleep under a roof, you can pay someone to sleep under their roof, that's renting, right? Or you can pay money to a bank and sleep under your roof because eventually you're going to own it. So in this challenging market, You may not get what you want, but you're gonna get what you need, right? And just because you don't get what you want right now, it don't mean you ain't gonna get what you want in the future. You know, I'm about to be 47 years old in a couple months, right? And just now in life, I believe I got what I wanted, you know? I got kids and I got a nice neighborhood with playground, and a swimming pool and basketball court, that stuff I wish I would have had when I was growing up. You can have that stuff in a trailer park where I grew up in Charlestown, West Virginia, in a trailer park, right? You know, you'd be lucky just to have food. So the thing is, it is challenging, but regardless, right? There's still opportunity. There's even opportunity in the midst of a desert, right? I tell people that yes, the pandemic was horrible, but a lot of us learned things from it, right? We were able to adapt, and there was opportunities we never even thought of until we was pushed into this situation, right? And what I know is when it comes time to find the right home for you, it typically comes down to this: where do you see yourself in the future? Because sometimes we think about, I just want to get in the house next month, and I just want to get the house because I just want to be in the house. But you're not thinking long term. It's now in my life, and I'm looking back at my 20s, like who's that 20s party? I was in the Navy, so I partied hard. Around the world, party hard, right? And in my 30s, I was just trying to figure out life, like honestly, who I was as a person, who I was going to be, right? And you really don't get it until you're in your 40s. And then you look back like, oh my God, if I would have known this in my 20s, right? So it's kind of like, yeah, I've been in the housing business, 17, 18 years, going way back even before that, right? But my mentality was that of a kid. You see, a lot of people look at me, oh, I'm 80 years old, you're still a kid, right? I guess I am still a kid compared to these people, right? So the thing is, you got to know what you want for your future. Before the prices went up, people would be like, I need to have that 3,000 square foot home, 5 bedrooms. I'm like, y'all just got married, have no kids. Yeah, but we're going to grow into it, right? Oh, we can't talk you out of it. They bought it. And all of a sudden, yeah, we want to downsize. See? They wasn't really thinking, So the thing is I don't know what the right home is going to be for you guys, but what I do know is we've got an excellent staff of people like Mr. Sean Coley right here and a couple other people here that we can guide you. We can ask the right questions. We like to use the word probe. In sales, probe is you ask the right questions to get a response so we can figure out what you're trying to do, right? But we can make sure that we ask enough questions and learn about what you're trying to accomplish, because the house, it is part of your future, believe it or not. And I can tell you a lot of people here may not even be thinking about in 10 years from now, when you get close to wanting to retire, they don't mean you're going to retire. Some people ain't in a position to retire, right? But I promise you, in 10 years, if you're in your 40s right now, you are going to be thinking about retiring heavily when you're 50. And I promise you, if you get this first house, and I know the rental rates are going up, that house may be your retirement plan. You might be downsizing, getting something, right? And then using this house to make money. I'll give you an example. Now, I didn't retire from the military. If I did, I would retire at 37 years old. I'm 47 in a couple months, right? And I got friends that retired at 36, and I went in at 17 years old, right? And they get checks. They probably get like $1,800 a month. So they get 50% of their basic pay, right? And they still work a job. You can't live off $1,800 a month. Not in Texas, right? So I got lucky because this house that I was in for 13 years, right? I said, well, I can probably sell it and then I can go buy the house in Montgomery, right? But I've been traveling before I had kids. And you have kids, good luck trying to travel and get kids on a plane, right? But before my kids came, I was already married, for 10 years. So we're like, we ain't got kids, let's make a little money and travel. I found myself staying in these things called Airbnbs and Verbos. Anybody stay in one of those? I'm like, I don't know how many times I paid $1,000 for like 2 or 3 days to stay in these people's houses, right? So I'm like, man, these people got a racket going on, right? So when it came time for me to get my kids into a neighborhood where they could play in the streets and I get hit by cars, I said, this Verbo deal is where I rent these properties when I travel, right? I said, they got a little calculator here. And it says list your property. I'm like, I never thought about doing short-term rental like I've been paying these other people, right? So I put my address in there. This thing said, you're gonna make $78,000 a year. I'm like, most people got jobs when they make $78,000 a year. I said, it's too good to be true. So I did my research, right? And I started looking at properties around the area. I'm like, these people getting like $199 a night. And I saw the hotels were probably like $199 for a queen size bed. So logically, I said, now I can see why somebody would pay $199 a night. Because why? If it's a 3-bedroom house and it's a queen size, then you get like a third off the price. And I know it because when I would travel, like when I traveled with my family to West Virginia, right? I never grew up where we could go to a lake, right? You know, get on a boat and go to a lake. You know, we just didn't have that growing up. We couldn't afford that. So when I went to Maryland, and I took my family, we rent a house. It was like a 4 or 5 bedroom house. I got my mom, my dad, my brother, his kids. We ended up paying like $3,500 just for about 5 to 6 days, right? So I said, man, if I pay that amount, there's probably people that pay $199 a night. So I said, you know what? It's by faith, right? I left my furniture in that house. We went and closed on this one. I started painting walls. I put up a brand new fence because it's fallen down after 13 years. You know, I put a little bit of new appliances in. I put a little carpet down. And I just said, listen, let's just go ahead and activate this thing on Airbnb. It was by faith. I didn't know what was going to happen. But let me tell you, we in February of 2022, I put that thing on the market, short-term rental, in February of 2021. It wasn't even a whole year that it was on the market. As soon as I hit that go live button, the bookings came in. Wow. That house guaranteed make me $6,000 a month. Remember I told you about the refinance? I got it down to $1,400. So I paid $1,400, but it makes over $6,000 a month. I didn't know anything about no Iron Man in the Woodlands. Every April, guaranteed, whole week book. People riding bicycles and doing, I don't know what they do in Iron Man. I'm not, that's not my thing. Weddings. People coming, we're coming to a wedding and there's 10 of us coming, right? They're not going to book a bunch of rooms at a hotel at $190 a night when they can get the whole house for that, right? People that need to do medical treatment flying in from Atlanta, Georgia, because we got the hospitals here in Houston. And they're like, we bring in the uncle, the aunt, and even our dog to support our kid that's got a surgery. And I just started meeting people from all over America and even the world coming. That house stays booked like 70 to 80% of the month. So me personally, I ain't worrying about a retirement plan because at least that house is my retirement plan. So what I'm saying is, but when I got that house, I did get a big house. Back then, don't choke when I tell you this, but I bought in 2008, right? I paid $198 for 4,100 square feet. And it's across the street from Exxon. The Exxon came in and the prices blew up, right? 5 bedroom, 3.5 bath. That's why I can easily fit 10 people in it. But I bought it because I'm like, I'm going to have kids one day. And I want to have a bunch of room for my kids, a big game room and all that stuff. And honestly, the kids finally did came. And guess what? They ain't got no playground. Yeah. And the schools wasn't that great. I wasn't thinking about schools back then. So I said, no, this ain't the right house. None of my kids came. And I bailed out, right? So when it comes time to look for the right home, understand that you got a lot of people with experience here on this team. We're going to make sure that we help you to make the right decision so that you don't make a 30-year mistake, right? Okay. So how much money will I need when it comes time to search for my home? We already talked about the down payment, right? And again, if you're military, no money down. If you buy a rural, which a lot of people are doing, we do have no money down program. But at a minimum, down payment, about 3.5%, just multiply that based on the house. Anybody got their tax refund check yet? Don't send it by the mail because you're probably not going to get it. Because people last year that did it by mail didn't get it, right? Do it electronically, but most people are getting enough money back. That takes care of your down payment right there, okay? Now, the earnest money, it is a deposit that when we do find that right home, we put a contract. You got to have some skin in the game to take that house off the market. Typically, it could be 1%, right? Or it could be as low as $1,000. So when you say this is the right house, I want to lock it up, take it off the market, nobody else can buy it. Boom, let's do the paperwork, and then here's my check. And then it's off the market until the day you're ready to close on it, okay? That's about the biggest portion you need up front to get it going. Now, when you find the right home, and after it goes through the inspections, which you do need to get an inspector to make sure you are getting a good house. Inspection fees could be anywhere from $400, maybe $450. on inspection. You hire the person, we give you a list, we go over all the deficiencies of the house, we can renegotiate if there's a problem, or you can just cancel the contract, right? But at least you know you're getting a good house. Once you know it's a good house, then you have what's called the appraisal fee, also known as an application fee. A lot of banks call it that, but it's an appraisal fee. That's where you pay the bank and they will send somebody out to take a look at the house to make sure it's a good house worth the money that they're going to let you borrow. Because remember, they technically own that house until you pay it off, right? So that's the appraisal fee. That typically could be anywhere from $500 to $600 for the appraisal fee. Okay. Now, option period fee. This is something that's unique to us here in Texas. Not a lot of other states have this. An option period fee is, I put a contract on the house and I put my earnest money up, but I want some time to rethink my decision because I want to wait for the inspection to come back, right? I want to drive in the neighborhood at night to see, is it really a good neighborhood, right? Because most people don't go looking at houses at nighttime, right? When we do a showing, you go in the daytime, but some people want to go back at night, just, hang out, park and look around to make sure it's a good neighborhood. But it ain't just about the house. Remember, I relocated to a whole other county because my neighborhood didn't fit the needs of my family. So I rolled out, okay? So the option period fee is a small fee that you pay to buy time to rethink your decision. So for example, I'll give you $100 and I want to buy 5 to 7 days. Let my inspector go out. Let me do some research. Let me check out the crime rate, see if there's any other lurking people that's in that neighborhood, because you got kids, what I'm talking about, right? Make sure you check on people in that neighborhood. And then if you say, you know what, I don't want this house, you have the right to cancel and you get your earnest money back. It's an option period fee. Some people call it due diligence fee. Okay. Now, how long is the process? Don't be the person whose lease is up. Like, how many more days we got in February? They be like, can you get me into a house like in 2 days from now? Because my lease is up. No, it don't work like that. So how long will it take? It depends on your personal situation. If you're at a 580 and you're like, oh man, I thought I was gonna get me a house at a 580, but this man said I'm gonna get jacked on the rate, right? I think I'm gonna wait to get a 640. Well, for that person, we may have to work with you a couple months to get you to 640 or higher, right? If you're someone that already has the credit, and let's say you already have the down payment money, right? It's a matter of let's get you approved for a loan and let's go look at houses probably tomorrow, right? And then you're at the mercy of, can we find the right home? There may not be a home for you right now in today's market, but every day, hundreds, if not thousands of homes come on the market. And the same thing, hundreds and thousands go off the market because people bought them up. So the finding the home, if you're a super picky person, it might take 2 months, 3 months, 5 months, 9 months. We just don't know, right? If you're the person that got the good credit, but maybe you don't have the down payment, we can look at down payment programs for you. But if that's not what you want to do, then it might be, well, let me save up a little bit of money for the next couple months, right? Or let me see how much I can get from my 401k. Everybody's different. But the main thing is, if you know you want to buy a house, you already made the first step because now you're thoroughly educated. So at least you know if you want to buy a house, right? And based on what we talk about today, you should know where you're at in the process. Because if you're like, I already got a 640 credit score and I know I got my down payment, right? You're already ahead of the game. We've been doing this, again, for a long time. We're not going anywhere. If you're not ready to buy a home right now, we're going to be here next year and then the year after and then the year after, right? But what I can tell you is we cannot rush you into a home. It's impossible because the government has checkpoints pertaining to the loan, right? Even if we got a contract on your house, we then would have to give you what's called the disclosures for your loan. And we have up to 3 days by law to give it to you. You cannot close on a home within that time frame. On the back end, when you're going to get the keys to your home, 3 days prior to your closing date, you got to get a closing disclosure. And those numbers are supposed to match the numbers we promised you up front. And if they're not the same, then there's certain government laws that kick in. For example, if we say your appraisal fee is going to be $600, and then the appraiser is like, oh, I'm behind, but I can do it, for $750, right? Because of COVID, everybody's gouging. Then you off by $150, right? Somebody's got to eat that fee because this is what we disclosed. So there's a 3-day window that you get to look at the final numbers, and in that 3-day window, you cannot close on the home. It's like a cooling off period. You see? So we got 3 days on the front, 3 days on the back. You got your inspector who has to go out to do your inspection. The appraiser might come out next week, and he might say, I'm so backed up for the bank, 3 weeks before I even get out there to look at the house. See? And these are things we can't control. I can't control an appraiser or an inspector. They're independent contractors, right? So we tell people at a minimum, if we find the right home, and even if we win the contract and we take the house off the market, at a minimum, you're looking at 30 days. So if your lease is up on March 30th, we ain't getting you in the house by March 30th, right? You may have to do a month-to-month extension wherever you're renting. That makes sense? Okay. All right. So the process, we just went over it. You guys got a little taste. When you meet with us one-on-one, we're going through another presentation where we're going to dig deeper into what we talked about. Because we teach in levels, right? Right now, you got the basics. You should at least say, hey, I know more than what I did when I came in. I either want to buy a house or I don't. But it's a group environment. Y'all are individuals. Everybody's different. So when you do want to meet with us one-on-one, the focus is 100% on you. 100% on you. Based on your background, your wants, your desires, your financials, your credit score. And then we have a mini meeting. People joke and say my meeting is like 2 hours when everybody else, on my team do like 30 minutes, right? But I'm a very thorough person because of my personality. But after that meeting, you're going to be approved. And then if you want to buy, then you're going to go out in the field and start looking at homes. Now, one of the things I want to go over real quick, you guys do have the handbook. If you don't have the handbook, let's say you're on Zoom, we'll get you the handbook. Some very, very important things that you need to know, okay? And then we'll almost be done. Number one, page 1, this is our mission statement of our company. You will notice on there that it says, our whole mission is to provide a 5-star client experience before, during, and even after you move in your home. Right now, we're in the before part of the process. So if you had to rate us from 1 to 5 right now, what would we get? 5? Okay. And we're going to make sure we keep it that way all the way through the process and even after you moved in your house and you've been living there for 10 years, right? Now, the other thing is we put our company values. Everybody knows that a company is made up of people, right? So when you work with our team, and I keep saying team, you do not work with one real estate agent. You're working with a company. That's what sets us apart from all the other real estate companies. You see, if you work with an agent for RE/MAX, you're working with one person that could be 150 agents of RE/MAX or Synergy 21. With us, you'll never work with one person. You work with the team, right? And when you're working with a team, you better make sure you know the values of that person, right? Because again, you don't want to make a mistake because you work with the wrong person. Now, when I say team, if you turn it towards the back, you will see the makeup of our team. Now, what I didn't tell you was there is a different level of real estate licenses in the state of Texas, right? There's a broker and then there's a sales agent. We've got 3 brokers. What that means is it's the highest license you can have in the state. Okay, so for example, I'm a broker in Texas, I'm a broker in Florida, and I'm a broker in West Virginia. In Texas, I'm required to have 900 hours, right? 4 years in a business, no disciplinary actions, and I have to take a higher level test on a national state. I've done it for 3 states, okay? I'm also a mortgage broker, which is the highest level that you can have under the Texas Bank and Savings Loan. Again, Texas, Florida, and also West Virginia, mortgage broker. So when you meet with us, you're meeting with someone who has credentials, okay? It ain't the guy who just got his real estate license yesterday. You're gonna meet with a lead agent. You're gonna go through one of us, right? And once you get through us, we're gonna know if you're ready to buy a house because honestly, some people are not ready to buy a house. They think they're ready, but they might not be ready, okay? And we're not gonna stake our reputation on someone that's not ready, and then it backfire on you. So we got our showing agents. These are agents that they take you out in the field and they will help you find that right property, whether it's a used home or if it's a new home builder. We work with all the builders in our jurisdiction, okay? In the Houston market, we cover 14 counties, okay? In the West Virginia market, we cover Jefferson, Berkeley, and in Florida, we cover pretty much 1/3 of the state, from Tampa all the way to Orlando.
So you only cover Houston, you don't do like Dallas? And-
No, we cover Dallas, but I'm saying you guys are locally here, right? Anybody here don't want to live in Houston in this room today? Where do you want to live at?
We live like somewhere around Dallas.
Okay, we cover you, Dallas. Yeah. So I just assumed y'all showed up. Did you even drive to Dallas down here? Did you?
I came in from Louisiana, from New Orleans.
Ooh, man,
But I
come
used
to a
to-
seminar?
But I used to live here and
Okay,
I'm gonna move back.
okay.
Yeah.
So these are our showing agents. Once you have a contract, you're gonna work with our transaction coordinator. It's like a personal concierge that's gonna hold your hand from the time of contract to the time you get your keys, because that is the biggest part of the process, that 30-day waiting time frame, right? Unless you build, it could be like 6 months. So they're gonna help you with the inspections, the appraisers, check up on the mortgage, check up on the status of the home if you're building it, but it's your personal concierge. Hilda, a lot of you might know, she's the one that when you call in, right? She's the one that's working the database, taking your calls and questions and text messages. This is Mr. Kevin, he's the office manager. This is Lacey, she's the one that made all this fancy stuff for us right here. That's Brent and Karen, they work in our credit department. So they help people that want to get up to that 640 to get that interest rate, and it's free. Right? For our clients, our credit program is free, right? Even Mattress Matt can't beat that. So they probably give you free cake, that's all I give you, right? So this is Philip, our photographer for our listing. Here's our insurance crew, because we do own an insurance company, right? So if you're like, hey, I want to make sure I get the lowest house payment, we're an insurance broker. We can shop hundreds of different providers. Providers you probably already have, like Progressive, right? You know, Allstate, these other kinds. Actually, there's our insurance agent. He's the guy in charge back there. If you just say, I want to save money right now on auto insurance, give that man, because let me tell you, I was loyal to Geico for over 23 years, and I thought nobody could beat Geico until he ran me through and gave me 2 quotes from 2 different companies. And honestly, I see the Progressive commercials all the time. I blew it off. I'm like, yeah, if they on TV, it's some type of scam, right? You know, plus the Geico lizard, right? You know, so they must got it going on, right? But he ran me through Progressive. Not only did I save $1,000 a year on my auto, but he said, you're underinsured. What do you mean underinsured? Like, yeah, if someone get in an accident and it's your fault, you know how much medical bills cost? Not really. So he doubled my insurance coverages, but yet my payment was lower by $1,000 a year. I didn't even know it, right? And then here's our mortgage team, right? So remember, I'm also a mortgage broker. My wife's a mortgage broker. We own all 3 companies, but we do have a staff. Now these guys, they're kind of like bankers, right? So that's why they're not over there. That's their mortgage company on that side. When you get done, if you want to take a tour of the facility, we can show you that, okay? So that's our team. But here's the other thing. Here's a fun part. When you turn, you already got it up? Okay, get it up. I'm not trying to find it in the book. That's a 23-page book with a lot of information, right? So one of the things that we're known for, right, is our member rewards program, right? Even if you don't buy a house using our company, there's still some perks you can get, like simply referring someone who does. We can give you up to $50 gift card in the state of Texas, because the law said we're limited on that, right? A bunch of stuff, you know, if you want to come in and we got free notary service. We got 3 notaries on staff here. Holiday giveaways for our clients. I know every Thanksgiving we buy them the pie for Thanksgiving from House of Pies. Anybody in House of Pies before? Right? So that's a benefit. But here's the main one that we're super duper excited because we believe COVID probably is gone, right? It just vanished, right? Ukraine came and then COVID went away, right? So that's how it works. That's how they do it, right? That's how they do it. So vacation getaway. Now, I don't know if you guys got this one right here. I know we had a stack right there. Right? We're going to hand them out. So check this out. This is one of the benefits or advantages of working with a company versus an individual real estate agent. As a company running a well-organized team, we do help a lot of people because we have a system. It's a streamlined process, right? The only way you can guarantee a 5-star client experience is you got to have multiple people working in unison in your favor, covering every single aspect of the sale. When you have that, you can do more volume of sales without sacrificing quality of service. Would you agree? Right? Kind of like Amazon. I remember when you had to pay for like the 2-day and the next day and all this stuff. Sometimes I order something on Amazon at 5 o'clock, it's at my door. I'm like, wow, these people got great service, right? And now they take a picture of it.
Yeah,
And I can see it on my phone. It's like they get better and better, right? But how can they do it versus these local mom and pop? They can't do that. It's because they're a well-oiled machine and they got the money to be able to do it. So with us, we're a well-oiled machine in real estate. And what we've done is we've actually gone out and we've bought several timeshares, right? So this is a perk that we pass on to our clients. And even if you're not a client, right? You don't even have to buy a home with us. If you just refer someone who's looking to buy and sell, you're going to be entered into a drawing to win up to 2 7-day, 7 nights vacations, right? The first one is 3 bedrooms, 3 baths. Now, how many people could take a lot of people with them if you got 3 bedrooms and 3 full baths? Right? At the Hilton in Orlando. But look at the time frame. What's the time frame? Do you know how hard it is to book a reservation on 4th of July? We booked it way in advance. And we got 2 rooms, a 3-bedroom and a 2-bedroom. So this ain't no cheesy little vacation, right? This is at the premier time of the year. So if you're going to Disney, I know they advertising the 50-year anniversary. They advertised that last year because I was there for it, right? So you're going to be very close to Disney, staying at the Hilton. But here's the thing. We're also going to offer $1,000 cash. It's going to come with it. Yeah. So some people say, well, hey, I'm just going to drive out there, right? Because they don't do the plane thing. Okay, we'll use it for gas. You probably need $1,000 just to get over here with the gas. Right? So, but if you want to get some plane tickets, you can do that. Or you could just get your tickets at Disney World, right? You can do whatever you want to do with that cash. So it's either you buy or sell a home with us and close by May 31st. That gets you 1 entry. But even if you don't want to buy anything, just refer people who may want to buy. And for every person you refer, you get another entry. Okay? You actually have that the link up. And how we do it is because I know this is kind of like the link is on a piece of paper, right? It's hard to remember. We can text message you the actual link that's to our website. We're going to actually pull it up for you real quick. It's very simple. Well, you actually had it right there.
Yeah, I'll show you. This is the home page. Just go to resources. Location getaway. Right.
Right, there you go. Now, here's all the people, right? They're already in the running. You refer someone or you close, your name's up there with how many. This is a client that closed with us about 2 years ago. See, they already know about our service, right? So they kind of got the advantage because every time they tell someone, hey, I use their program, it works, look at me, y'all came to my housewarming. But it doesn't matter if she got 8, right? It's the luck of the draw. You only need 1. It's the luck of the draw, right? But these are what I'm talking about, the benefits you get before, during, and even after. And if you guys are here today, you already have an account with newhomeprograms.com. You have a member's account. If you're getting emails and property listings and text messages, you already are a member of newhomeprograms.com. So why not take advantage of some of the member offerings that we have? And not all of them, you got to buy a house, right? Okay. All right. So Mr. Brent, he has a form in his hand. I can see it. This is a form if you want to get a free credit analysis, which does 2 things for you. Number 1, find out which program you qualify for. Number 2, find out how much you qualify for. Because when you have those 2 items, then you know if you're ready to buy a home. If you know you're not ready, don't fill it out because what we got to do is we got to pull your credit and that actually costs us money that we pay for, right? So if you say, I know I want to buy probably in the next 90 days, go ahead and fill it out. We'll give you the free credit analysis, and then we'll tell you what you need to do. Okay? Because I know there's some people, it's like, hey, I'm going to buy 2 years from now. Everything's going to be different 2 years from now. Okay, so we don't want to waste your time and say, oh, you can get this, and then 2 years from now, you're like, hey, you told me this 2 years, so we don't want to waste your time.
So if you fill this out today and you want credit enhancement, that's what I do. I will get you into our program. Like you said, the program itself is free. It will cost you a monthly service charge for me to get access to your credit report that does not affect your credit, okay? If he pulls your credit, you're gonna lose some points because you're
Maybe one or two.
If you go with me, then you won't lose any points. You're allowed to, monitor your own credit, and I will take it from there. So those are the two options when you fill this out.
So for someone who says, I'm not ready, but I still want to work on my credit to get in the best situation, he works on the credit enhancement program. But for someone who says, hey, I need to do something like right away, then we will pull a full-blown mortgage credit report, run it through the automated underwriting system, and then see what types of programs you are qualified for.
So if you need one of these, let me know. And I'll get it.
Okay? And then for the people on Zoom, we will send it via DocuSign if you guys do.
We have some hats, if you want to add this. Raise your hand. Complimentary.
Okay, what's your question?
So think about the foreclosure homes, like purchase.
There's not a lot out there because the values have gone up. So why would someone lose their home to a bank when they have equity in it? They can just put it on the market and sell it and walk away with $100,000.
That's a good, he's international.
Okay. Yeah, get that over to Millie because there is a way we can get an international credit report. Yep. What's that?
You call me like, hey, on my car. I'm like, I need my time. I need my time. And boy, it was daggone. I'm in the I said stuff, yeah.
Do the credit enhancement, but there are some things that we can do to speed up. For example, you pay rent, right? We have a program that can backdate your rental payments up to 2 years on the credit. That right there can probably jump up.
I know. Did you play that like yeah. So for that time, I'm more of I don't know. He doesn't tell me that drama is absolutely necessary. I know. So,
And we want you to, because if we don't get you to a 640, then buying a home is going against you because you're gonna get a higher rate. Like for sure, we gotta get you up to 600 to really get you qualified. 640, we know. we can get approved. So we need to make sure we get you at 640.
The main thing is
Don't pay off fees. Just like rent, free credit analysis, he'll tell you, like, we have a full blown service, we're gonna show you all the negative stuff, but at the same time, we're gonna show you how to build your credit by adding more stuff. Yep, the grant will take care of it.
And I really a little bit of.
Okay. Really? Only $50,000.
I don't want you to have to tell them. Your mom and your she's gonna tell you how. I'm ready. Yeah. Take a picture of her on the sign, so that I can put it on. No, you're not. It's for our board. It's internal. It's not gonna be on me. So I just need that for my board. But it's good to see you. Okay. Hola. Hola. Me estaban esperando. Yo estaba esperando y dije, pero lo estaba esperando no para que vinieran al seminario, sino porque yo le iba a dar más cortito. A ver, vénganse conmigo.
You want to play basketball with you?
No. No voy a necesitar botas, no, pero quiero que te quieras como que sí,
Lay hands on it. Lay hands on it.
It's already being done.
They don't always. After we disputed it, we take several rounds. I got this.
But you know what? I just got a lot of problems. All right, be careful.
And if you pull supplemental, this charge off and this off, you can get 40 points. So when you up and high enough. That's what we care about the issue right now. While we're disputing, we wait till the end, and then, you know, but it's not, I need the supplemental report. It'll either tell you, pay this, what we need to do. I didn't want to pay nothing. And then you go, and pay that. They say you money.
We won't run it through the Airbnb. Because not
Credit card your credit card, the amount of money you owe.
when you have a
Pay an
house.
installment. You pay that $600 a month, if you give them $10,000.
Yeah,
You're still.
so some things can be very low, they start from.
So you're better off to pay $10,000.
If it's a thing in the neighborhood, then you may have an option.
So she's like, well, no, that's what we want.
I need it. And once I read the deed restriction, I will know if you can get it off. In my neighborhood, I want to not eat, they will start paying. And back then, they never had a dog.
So
Because that law said you can't do commercial business, which you could look at Airbnb and a hotel. The problem was, is when a lot of these older HOAs started finding people, there was a guy who was a military guy, he took over the Supreme Court. And the Supreme Court says that if it comes to person to put the dog on a pillow and it's residential, you just can't reclass that commercial just because of what it's changed. So the Supreme Court made a decision in Texas that unless you don't have it in the HOA, you cannot do short term. I follow it. And then the HOA said, oh man, the Supreme Court knows gonna take it where people can do little.
mine's.
So then they